Hmm. Yo, what's up for everyone on the YouTube replay? I hope you're having a great day. Let's start this off with a quick portfolio update. Then I'll get into some stocks that I think are going to be great buying opportunities next week. As we know, there's a lot of fear in the market right now. We've had a rough week, actually a rough month. Let me just show you my portfolio. I love being fully transparent. We're down 10% the past month. So there's a lot of stocks out there that are starting to get to some very attractive, buy the dip opportunities. And we'll definitely go check those out. So yeah, let's start this off with a portfolio update. Here's my Robinhood account, known as my dividend only portfolio, where every stock in here pays a dividend. It is down 10% the past month. And over the past year, it is still green 11.38%. Let's actually compare that to like the S&P 500. Over the past year, the S&P is up 16. So yeah, we've definitely underperformed the S&P 500 a little bit. Here's my total percent change on every stock. So luckily we are green on every stock except for Carlisle Group, but that one has just been really interest rate sensitive. Actually, my newest position, I think you'll like. It's very interest rate sensitive, but yeah, Carlisle is the only stock where total return red on. But if we go over to our Roth IRA, the new stock we just bought for the first time ever is a high dividend play. It's a REIT. This is CTRE. It's one of the most underleveraged REITs I've ever seen, and they have like a 3.8% dividend yield. We're down 3% all time on them. But yeah, here's my total percent change on every stock in here. This portfolio has really been struggling the growth. We're down 12% year to date. Cormedics, Webull, they've really been the big losers in this account. And then we have our Webull portfolio. This is like our risk on account. We're up 5% all time in here. So definitely not too great of a performance to only be up 5% all time. But yeah, here's my total percent change on every stock. So yeah, we're down bad on a lot of software names like UiPath, Zoom, Sprouts Farmers Market a little bit. But yeah, we do have some big winners, but we're only up 5% all time in here. We do have some like losers that we've completely sold out of, like ChargePoint. That was a big loss for me. But yeah, how are we doing year to date? Probably not too good. Yeah, if you look at the top middle there, we're down 9.6% year to date. Luckily, we do have some good dividends coming, or that came in this year. Like Progressive paid a $55 special dividend, which is pretty cool. Like Southern Company, AbbVie, Calmane, I get some nice dividends from them to kind of offset some of the losses. But yeah, finally, we have a Moomoo account. This is called my buy and never sell portfolio because once I buy a stock in here, I never sell it. And these are all the stocks that I own: Comfort Systems, Powell Industries, Coca-Cola Consolidated, Amazon. This one's, I think, a steal of a deal right now. One of the best buys in the market right now. Amphenol and Moog stock. This is my most recent purchase in here. But yeah, what's up, everyone? What's up, Tommy, Plasma, AJ? What's up, y'all? Good to see you. Kylie or Kai. I mean, yeah, do you buy Futu? Absolutely. I love this stock and I'm trying to buy more. They're actually, I believe, my second largest holding. Yeah, look at this. They're in this portfolio. We're only up 2% all time on Futu, but I really think it's one of the best stocks out there right now. But yeah, someone asked, would you ever buy into NVIDIA? And the answer is potentially yes. I really think right now is a really decent price on NVIDIA. Actually, from a technical point of view, I guess this app is telling me that there is a 63%, I guess, bearish continuation triangle, a 63% chance it goes down, but oh well, that's technicals. I judged them off the fundamentals, and NVIDIA's financials are so strong. I think they just came out and said they're going to sell like NVIDIA projects over 1 trillion revenue visibility through 2027. NVIDIA and Uber to deploy autonomous vehicle fleet. Wow, so they're partnering with Uber. NVIDIA plans to return 50% of free cash flow to shareholders through buybacks. Wow, so they're going to do a ton of share buybacks because the stock is actually pretty cheap. NVIDIA restarts H200. I wanted to find the news around Amazon. I think they plan to sell like 1 million chips or something to Amazon. Elon Musk confirms SpaceX AI and Tesla to continue large-scale AI purchases. So anyway, this is like the backbone of AI. Everyone uses NVIDIA chips. And check out their GPU market share, 24% GPU market share. But here's why I think the stock is actually, if you buy it right now, you should get like 10% returns a year simply because of this forward PE. If you look on the left, you'd say they're a little expensive at like a 35 PE, 35 times net income. But it's when you look at the forward multiple, NVIDIA only trades at literally 20 times next year's net income. And I'll show you the numbers for yourself. Here's what analysts are projecting. It's going to go from, on the left, 26 billion net income to 46 billion. There's literally still going to be 100% EPS growth or in net income growth. It's like, I can't believe that. If you annualize 46 billion, that's basically 200 billion of net income a year. And that's how they get the 20 forward multiple. They have incredible net margins. So the total revenue this quarter was 68 billion. Out of this 68 billion, they kept after taxes $42 billion, which means their net margin, this is insane, is a 63%. So you go spend $100 on one of their chips, they keep $63 of it after tax. And they have a fortress balance sheet. They return a lot of money to shareholders. They're making a ton of investments into like Intel. Actually, we can see the NVIDIA portfolio real quick if anyone's curious about that. Here we go. These are all NVIDIA's holdings, like they own a bunch of Intel, CoreWeave, Synopsys, Nokia, Nebius, those kind of names, CoreWeave. So yeah, the 20 forward PE actually seems pretty fair for NVIDIA. The only thing though is like the law of large numbers. Like if you look in the top right, the market cap, NVIDIA's worth 4.2 trillion. You know, for you to double your money, they have to be worth 8.5 trillion. So it's just it might be a tough double just from the law of large numbers, but I wouldn't be surprised to get S&P 500 type returns every year, just like 10% returns a year. Pretty cool. Yeah, hey, the very first, it's in the link tree in my bio there, the very first link. If this is a brokerage I'm on, if you want to get this thing I'm on, broker called Moomoo. All right, hey, good morning. All right. So thoughts on Main Street Capital and QQQI. Yeah, that's mainly a dividend play. You buy this to maximize your dividend income. This has been one of the better performing monthly paying stocks. So there's a few stocks there that pay monthly dividends. And this is one of the few companies that pay monthly dividends that's quite sustainable because this is a BDC, and BDCs by law have to pay out 90% of their taxable income in the form of a dividend. So if you look at this, you literally get 30 cents a month with this company. And so if you buy the stock, you get 5.6% of your money back just in a dividend every year. It's a non-qualified dividend, so it's taxed as short-term capital gains, unlike normal dividends, which are taxed as long-term capital gains. But anyway, yeah, you buy this to maximize your income. They do lending, first lien loans, second lien loans, and they take like private equity stakes into certain companies they lend to. So yeah, they're a good one to maximize income. All right, let's see here. Bro, gold ETF is crashing. I'm in shock. Yeah, IAU is the ETF for gold. It's literally the commodity of gold, just in an ETF, IAU. Sorry, I guess my Wi-Fi is a little slow right now. There we go. Yeah, look at them the past 2 days. I mean, really weak. They gapped down from 95 to 85. I mean, they have had a pretty crazy rally, you know, before all today. So maybe they're just having a little healthy RSI retrace or something. Hopefully the bottom's close in for gold, but who knows? All right, let's see. Hey, what's up, Muhan or MUHN? Good to see you, man. Long time no see. Hope everyone's having a good Sunday. We stream every Sunday this exact same time if you want to hit the follow button. So speaking back to NVIDIA, I just saw someone talk about AMD. I actually bought AMD over NVIDIA simply because of that law of large numbers thesis. NVIDIA's worth 4.5 trillion. For you to double your money, they have to be worth basically 9 trillion. Well, AMD is worth 300 billion and has pretty similar growth, like really impressive growth metrics. They're still a little expensive, but look how much the forward PE is improving. That's why you do a PEG ratio or like a multiple year out forward PE, but it's going from a 75 to a 44. So the net income is basically doubling year over year, which is still such good news. It's having like this year's double. And they've been beating on expectations every quarter. Like the orange line is what the analysts expect them to report. And look, for the past 3 quarters in a row, they're beating on their numbers. And actually, it's mainly from the data center business that's beating. Look at that annual growth here. Actually, let me pull up quarterly. It's up 39%. After grew 69. After grew 38. So they're on a streak of growth. Like this is the highest quarter ever for their data center business. You know, it was 5.4 billion just this quarter. And they have all their other businesses like client. How's that doing quarterly? Look at that quarterly growth. I mean, I don't know if they should benefit from the memory shortage, but yeah, if we just zoom out, I mean, look at that net income. I mean, that's what you want to see. Basically a record net income this quarter. The growth is finally back to the sales. Nice double-digit growth. Like if we zoom out, yeah, that's great record growth. Never been higher quarter. 10 billion of revenue for the first time ever. And they have a fortress balance sheet. No net debt on AMD. And they print free cash flow. Look at that. So, yeah, I have no real complaints except the valuation is still a little bit pricey, 44 forward PE. But I really do like AMD. I'm a shareholder. Let's see if there's any news. AMD and Celestica partner. AMD and Samsung. U.S. Department withdraws draft regulation on AI chip export. Oh, yeah, that was really bad news like a month ago. But now it's gone, so that's good news. They basically needed permission to send chips to China and stuff. Supermicro just got in a bunch of trouble for that. Anyone see that news? Like Supermicro employees arrested on this news. Supermicro computer co-founder resigns after DOJ charges three individuals with exports to China. Like that's why the stuff. Dang, RIP Supermicro computer. All right, what happened to Grab and is Microsoft a good price now? Let's cover it. What's up, Mr. NA? Let's do Microsoft actually. I love this stock. It's literally gotta be one of the best buys to like ever exist right now. Hey James, dude, thanks for those creepers there. I appreciate you, man. What's up? If you got a stock you may look at, let me know. So here's Microsoft, one of the best stocks to legit buy now, and you can just sleep well at night. So they own 27% of OpenAI. So you get a big exposure to basically AI, ChatGPT. They own 27% of it. Let's see if there's any news here. No, I'm not really seeing much. But anyway, they're also categorized as a software name. A lot of software stocks, like if you look at Adobe, you look at Salesforce, they're all tanking right now. Their valuations. And Microsoft is a big software name, possibly the biggest software name in the world. Think of Office, PowerPoint, Excel, 365, all that. That's this business right here. And if we go to this on an annual basis, this software business does over 120 billion of annual revenue for Microsoft. And look, check out how growthy it is. Like I'm so impressed by this. And that's one of the reasons why the stock is falling. But I also love their cloud business, their Azure cloud. It's the second largest market share behind AWS. This also does over 100 billion of annual revenue for them. They literally have a better credit rating than the U.S. government. The U.S. They're more likely to repay their debts than the U.S. government. Look at the net income growth. It's going to be like 30 billion a quarter for the next 2 quarters. Like they're going to be making over 30 billion of after-tax net income a quarter for the rest of time potentially, and they can just invest it all into the future. Like they buy a bunch of OpenAI and they're up so much on that investment, and they're expanding Copilot. So anywho, and all their software names. I think this is one of the best buys because they literally, I can't believe this. Behemoth Max 7 Microsoft only trades at 21 times next year's net income and 24 times current net income. I mean, I that just seems so cheap. Like in terms of valuation, I mean, how much cheaper can Microsoft get? I don't know. And every company in one way or another uses Microsoft. I mean, I'm on a Windows computer. So anyway, Microsoft's great. Just like one of the best stocks. Hey, well, shout out member Brian Paul. He said being down 10% last month isn't bad for volatile tech holders. Yeah, yeah. If you're, he's referring to this right here. Check this out. If I go to my Robinhood portfolio right here, the past month, I love being fully transparent. We are down 10% the past month in this portfolio. All right. Yeah, war oil is another reason why, Jay. Yeah. So Plasma said JCI. I think this is Johnson Control. This is another comfort systems type stock. I really like this one. Well, they don't do exactly what Comfort Systems does, but they trade relatively cheap. I mean, the current PE is only at 24. So this company trades at 25 times net income. Let's see the net income. So the probably they trade cheap is because they have like single digit sales growth. Like look at the revenue growth rate, that green number at the bottom, like it's 6%, 3, 2, 1, 4. So like single digit growth. And that's why I think the multiple is like a 24, not like a 30 plus. But look at this net income. Jeez, they make easily like over 500 million to a billion of real net income a quarter. You get a dividend, so you buy the stock now, you get 1.2% of your money back just in a dividend every year. 25 PE, products and systems, services. Where do they do that? So 56% comes from the United States. Let's see what they do exactly again. Oh, actually, they're actually headquartered in Iceland. So this isn't a U.S. listed company, or well, they are, but I mean, they're headquartered in Ireland. Uh, Provision of building products, energy solutions, integrated infrastructure, next generation transportation systems, security, HVAC equipment, building automation. So that kind of industry, a pretty attractive multiple, actually. Maybe it's because they're listed there. Yo, what's up, him? They call me. What's up, dude? All right, let's look at some more here. Hey, what's up, Sapire? Thanks for that gift there. How's it going? COKE is one of my faves. Yeah, dude, Coca-Cola Consolidated. This is a nice defensive name, and I love the mission here. So, one of the reasons why the stock has done so good is because they bought back, and this is rare, a company does this. They bought back 22% of all the shares that exist at $127 a share right on this day. So, ever since they announced that share buyback of buying 22% of all the shares, the stock has just been a rocket ship, which is pretty cool. And then hopefully I'm not lagging there. Sorry if it lags for a second, but yeah. I'm just so impressed with this company because of the buybacks and they have a lot of pricing power. It's a really boring company. Like I bought this stock for it to do good whenever tech is doing bad. I bought it for its defensive nature, and it's kind of doing exactly that. The stock has done very well. Kind of see on my buy orders right there. Hold on, I might have to re-screencast my phone here. I had a quick little like hiccup in the Wi-Fi and it makes me reset it. Sorry. There we go. But yeah, Coca-Cola Consolidated. I'm very impressed with this company. They're a Christian values company. Look at this stock price appreciation. Been one of the best performance stocks out there. So let's see their net income. Where you really look at the operating profit, like this is why the stock has been so good. Like in 2017, it was a tough buy. They were making like, I don't know, lucky to make 10, 20 million a quarter. It was really choppy, the net income. Well, now, I mean, it's just like so good. It's like 250 million a quarter. So they do really have good pricing power, expanding margins, and that share buyback. So whenever they buy back 22% of all the shares, it literally gives you 22% more ownership in the company, makes a dividend cost 22% less. Just pretty cool. Which brokerage you using? Yeah, hey, or Jim, it's in the link tree there. It's the very first link if you want to get this broker I'm on. Hey, what's up, Cruz? Shout out to member Cruz. Good to see you, man. Market's cooking me. I just OT to grab some dips. Yeah. What about ServiceNow? What's up, Tom? Tom? Yeah, this is a big software, like subscription software name. One of the main software stocks that are getting hit. On the software dip just because they're like the largest market cap. So let me actually analyze this stock right here. I think I have some good things to say about them, except they're a little expensive. Sorry, man. I don't know what's wrong with my Wi-Fi or my screencast today. It's a little slow, so I apologize. But yeah, here's ServiceNow right here. They are on a massive dip. But even though they're on a massive dip, they're not super cheap. Like if we go to a forward PE, where is this? Forward PE, they're still at a 46 forward PE, which is a great improvement from the 66. But a 46 forward PE is still a little bit expensive, but I love their subscription business. Let's see if we can get some AI news here. Yeah, check this out. So their subscription revenue grew 21%, exceeding expectations, and they have a contracted backlog. So literally in contract, they have a backlog, and that backlog increased 25% year over year to 12.85 billion. So that's incredible. You know, that's so much long-term stability to have 12.85 billion in a backlog, like in contract with large deals and customers, ACV over 5 million, expanding notably. That's great news. So yeah, they're already profitable too. A lot of software names are struggling with profitability, but look at how they've just improved their profits over time. So, I mean, they're easily making like 4 to 5. They're easily making like 4 to 500 million a quarter. They're investing in the future. I think they're doing some acquisitions. Let's see if we can find any news. No, not really. There are no news covering them right now. But yeah, I really like this one. One of the probably the most quality software stock to buy. They're a huge mega cap. Like over half the S&P 500 are customers. 115 bill market cap. But so the 46 forward PE might mean it can go a little lower, but the PEG ratio is really cheap. Yeah, hey HH again. If you want to get this app I'm on, or it's a broker, it's the link tree in my bio there, the very first one. Broker called Moomoo. All right, let's see. What are you throwing money into this week? I'm actually looking to buy more of the stock I just bought. Yeah, let me actually show you the stock I just bought for the first time ever on Friday. And then I'll look at y'all's stocks again. This is Care Trust REIT. It's a real estate investment trust, which means they have to by law pay out 90% of their taxable income in the form of a dividend. So this is kind of a dividend play, but it's not just a dividend play. I think they're going to have great stock price appreciation on top of this because of the industry that they're in and because they're low leverage. So yeah, look at this. They fell 8% off Friday. Like every REIT fell like this. Iron Mountain fell like 5%. Every REIT tanked. But yeah, this is a triple net lease REIT, which prints money, you know, literally 99% gross margins. But check out the growth here. This is just boring revenue. Revenue's up 55, after grew 45, after grew 15. So they're on a streak of growth. Insane streak of revenue growth. Like this is what you want to see. And here's the net income as well. You really don't look at net income for REITs because it doesn't add back the depreciation and the amortization. But even if you did look at net income slash EPS, you only traded a 23 net income, 23 times net income. But it gets even cheaper when you look at the the depreciation and amortization down here, which is basically AFFO. Also, basically no debt. They could pay off all their debt in 0.5 years. Debt to EBITDA ratio of 0.7. They have like 300 mil of cash, 700 mil of total debt. So like I am so impressed with this balance sheet. And like this is the metric you look at to do a dividend payout ratio from, and it's just at a record this quarter, 120 million. So let's go see how much the dividend costs. And the dividend cost should be rising with the money because they literally have to pay out most of this in the form of a dividend, or else they pay massive taxes on it. So it usually makes sense for them to just return it to shareholders. Yeah, look at that. On the very right, the dividend only cost him 75 million, which could easily be afforded here and easily be afforded here on net income too. And yeah, 3.8% dividend, slightly higher. They have a 3.8% dividend and a safe payout ratio. And I just love the acquisitions. And let me show you the industry that they're in. They're specifically in healthcare properties, like the specialty nursing, senior housing care, which is kind of a defensive like industry, I think. Here's some of their properties. Like some of they just bought like this huge UK senior housing portfolio for like $800 million. That's another reason why they're growing so much. So anywho, very bullish on this one. My newest position, I don't own too much of them, but yeah, if you're looking for a REIT with a nice 3.8% yield, kind of in a cool industry, I like that one. All right. Let's see here. Can you do IONQ? Nathan Boss, another red week ahead. Maybe, Bitcoin's a little, we might have a rough beginning of the week, but I think toward the end of the week, we'll probably rally up. So, I see Visa. What's up, Pog? And Yuri, I see Adobe. You got some good names here I might check out. So here's IONQ. I don't love this one because they're overvalued, 11 billion market cap. No forward PE, but this is a quantum name, and they're one of the more better quantum names because basically what they're doing is they're diluting the life out of the shareholder. Like they just diluted every shareholder by like 20%, but they bought a company for like $1 billion. They're doing these great acquisitions. So they're kind of taking advantage of the high stock price, which is a smart thing. But yeah, revenue surge due to customer adoption. 100 million in annual revenue. I think it's like now 200 million because of a new acquisition. Actually, let me just go down here. Look at the revenue. So yeah, look at this quarter, 61 million of revenue. Where'd that come from? If we go to our cash from investing activities, wow, it was even more than I thought. Dang, they bought a company this quarter for $1.2 billion, then the quarter before for 700 million. So that's why the revenue is so growthy. They're buying these companies, and that's just like, so oh dang, they lost 220 mil in net income this quarter, 170 mil last quarter. So they definitely want to see them start to narrow these losses. But yeah, I would not personally own this one. It could be maybe a fun little short-term swing trade or something. If I wanted to long-term hold it, I'd keep it as a super, super small position. But yeah, I guess it's those acquisitions that they're doing. That's what you really want to look at. All right, so Visa. Let's do Visa. I think Nancy Pelosi's a big holder of that one. So, let's pull up the Nancy Pelosi portfolio. She got Google as 19% of her portfolio. She has Apple. These are all great stocks. Actually, Visa's not in her top 10 anymore. Huh. Well, anyway, that's all right. Ticker symbol V. This one's seen a lot of like fears around like the private credit market and cryptocurrency card fears. But Visa's like, we're not going to get out innovated by these stablecoin crypto cards. So they're actually making their own. Visa expands partnership to launch stablecoin linked card program across 100 plus countries. Visa launches trusted agent protocol. Bank of America reiterates a 410 buy target. Dang, $410. It's 300 today. Here's why I think Visa really is a good deal. Yeah, hey, what's up, McSpicy? This app I'm on, if you want to get it, it's in the link tree there, the very first link in my link tree. It's a brokerage, actually, where you buy stocks on. But if you look on the very right, Visa trades at only 22 times forward PE, which means they only trade at 22 times next year's net income. That is incredible for quality Visa. Like, here's their after-tax net income. They are literally a money printer. This is after tax. They make easily over $5 billion of net income a quarter. And what is Visa doing with $5 billion in net income a quarter? Well, they're returning it to you as a shareholder. First off, they pay a dividend, and that dividend only cost $1.2 billion. So there's going to be a lot of future dividend growth. But the best way they return money to the shareholder is share buybacks at the top. Look at this. They buy back like 4 to 5 billion of stock, just like for all of eternity, all the way back. We can go to 2021, 2022. That is why the stock does so good. And I think it's a good buying opportunity now. They return, you basically get 3% of your money back just in share buybacks. And you get basically a close to 1% dividend. They raise their dividend so fast every year. So you get a 1% dividend, 3% share buybacks a year, and you should get 3% stock price appreciation. I really think, not financial advice, you buy this now, you should get like 10% of your money back a year. I really think the risk to reward is starting to look very good. I don't see Visa get much cheaper. I guess it's kind of all fintech stocks are struggling right now, like a JP Morgan, a SoFi, all these kind of fintech names are all like a good 20-30% off their all-time highs. And Visa is one of the more quality ones to buy. Everyone has a Visa card. All right, Adobe forward PE of a 10. Let's check it out. All right, Adobe, this is one really being hurt by the AI thesis fears. Actually, one reason the stock just tanked, and I watched this exactly. I watched like the news terminal when it happened. Google announced, and I'm going to forget it now. Google Stitches, and it is a literal direct competitor to Figma. It actually tanked Figma the most. It's basically a Figma replica. The minute Google announced this, I wonder if I can find on the 5-day chart. Yeah, I think it was like right here. The stock fell. There was no earnings report. It was just this Google app that they released called Google. Oh, here it is. Google Labs launches AI-powered stitch design platform, intensifying competition with Figma. It's like a direct replica of the app. I couldn't believe it when I checked it out. But anyway, basically the thesis is, in 10 years from now, will we need Photoshop and these products as much? Because can't we just Google Gemini, create a logo, Google Gemini, create that thumbnail, whatever. So that's the fears around Adobe. But the thesis is, if you buy the stock now, are those fears just way overpriced? And it's way too overdramatic. They're only at a 13 forward PE, so treat it 13 times next year's net income. Big subscription model company. Let's see if there's any news. Adobe partners with NVIDIA. Wow, okay. This was a weird sign on earnings day. Adobe CEO retires out of nowhere, especially at such a critical time. Like, the CEO quit, at such a critical time when the stock tanked. So one of the reasons they fell on earnings, they had good earnings, but the CEO quit out of nowhere. No successors named. I wonder if the board pushed that or something. Adobe settles DOJ $150 million over subscription practices and cancellation procedures. They make it impossible to cancel your subscription, and that was a big other pain in the thing for Adobe. They finally got that settled. But anyway, look at this quarter. They beat on revenue, they beat on net income, they beat on EBITDA, but the stock fell just because of sentiment fears. So one thing they're doing right now is share buybacks. So here's their net income. Adobe really does print money. They make 1.8, 1.9 billion in net income a quarter. What are they doing with all that money? Well, right now, I wish they do a buyback, but if we go to their stock buybacks, look at this. Why is this so zoomed out? I don't know. But just the past 4 quarters, they're spending literally over $2 billion of their net income a quarter solely buying back their own shares. And unfortunately, all the buybacks they've done have been unfortunately timed because they're at a new 52-week low today. But anyway, you're kind of just a thesis around what will AI do to this? If you're a believer, will humans always need the final touch on art? I kind of think that, humans will always want that final touch on art. But I'm kind of just staying away from this one. A software stock I bought that was on a massive dip, my most recent software purchase. Here's actually all my most recent purchases in order. My most recent purchase is actually AppLovin. I bought them back a week and a half ago on this dip. I said, this is the most quality software stock to buy. And it's on a massive dip too. So actually, let me know if you want me to go over AppLovin, better margins than NVIDIA. So Adobe, I wish they'd do an acquisition. Don't buy back, don't spend $10 billion a year on share buybacks. Wait, what's the market cap? Geez, the company is worth $100 billion. If they buy back $10 billion of stock like they did the past year, they buy back 10% of all the shares. Kind of crazy. What app are you using? Hey, it's in the link in the description, link tree in my bio there, first link. All right, let's look at some more here. What's up, Dino? Is Campbell a good buy? Yeah, good dividends. Campbell Soup is just not a great stock you really want to buy to outperform the S&P 500. If you just buy boring Campbell Soup, I really don't think you'll outperform the tech-heavy S&P 500 in the long run. It's kind of a dividend play. Dang, look at this. I think there's a more quality, more food stock to buy on a dip, like a Mondelez. That one's a great one, MDLZ. But check out this company right here. This They own Goldfish, Campbell Soup. They own all the soups and they own Goldfish and stuff. A lot of commodities, low single digit margin commodities. Looks like the revenue is negative 4.5% year over year negative growth. Profits are down too. Well, here's the thing. Here's their operating profit before tax, before adjustments. They're making 200 to 300 million. So they're making that's before tax. So they're making 300 mil before tax. The dividend cost 117 million. So as long as they're making over 117 million net income, they can't afford the dividend every quarter. And here's their actual net income every quarter. So nothing's just blowing me away here. I know there's like a General Mills is actually kind of decent too. Like all these, it's not just them that's on a dip. Like look at General Mills. Like it's not just like them exclusive that are having a rough time. But the most high quality one that hasn't dipped as much, but it's still like I think a better buy is Mondelez. You still get a good yield, 3.5% dividend yield. High quality brands like Oreo, Toblerone, Tate's. They have so many Sour Patch Kids. They own so many good brands. How can I see your portfolio? Hey, Momo, what's up? Thanks so much for the gifts there. Yeah, if you, or I can share with you my portfolio right now. I actually just made a YouTube video where I just go over every single stock that I own and all my portfolios. So if you actually just go to my YouTube channel, you can check it out there. YouTube channel is called Nathan Robert. You can just type it into YouTube. I'm also streaming on there. If anyone wants to watch it from there, it'd help me out. So let's look at some more stocks. Yeah, what's up? IBM, please. Yeah, hey, my bad for, sorry if I'm missing some stocks here. There's so many, like stocks I want to get to. I just apologize if I can't get to them all, but we're going to be streaming for another almost 2 hours more. So don't worry, I'll try and get to all these. And we stream every single Sunday, this exact same time. If you guys want to hit the follow button, I sell nothing at all. I have no course book, WhatsApp, literally sell nothing. I'm just going to give my opinion about stocks. So here's IBM. This is actually a good quantum play. Let's see if there's any news. IBM expands NVIDIA partnership. IBM completes $11 billion acquisition of data streaming platform Confluent. Wow. And Confluent serves over 6,500 enterprises, including 40% of the Fortune 500 companies. Wow. So I've never heard of Confluent, but looks like they just did a $10 billion acquisition. That's like almost 5% of their market cap. That's actually a pretty significant acquisition. And they're actually not exactly expensive. If we look on the right, they trade at 21 times net income. Well, look at this. Their current PE is at 21 and the forward PE is at 21. So I guess they're expecting no EPS growth, but still that's a cheap valuation, a 21. Like I could see this stretching up to like a 25 PE and send this back up to all-time high. So actually probably one of the reasons they're falling, as we know, a lot of software names are falling like crazy. We saw Adobe, Microsoft, ServiceNow. Well, it looks like half the revenue is software. Then they're also in consulting and infrastructure. Let's check out the profit growth. Yeah, here's their profits right here. This quarter specifically was the most profitable quarter they've ever had. 4.85 billion. Revenue grew 12. So back to double-digit growth. So you see, that was the thing. IBM, like if you look a year ago, look at all the year-over-year growth rates on the bottom, that green line. It was just 1 or 2% revenue growth, but now they're bringing back to the double-digit sales growth. Plus that new acquisition, I'm really curious about how that'll go. So their software revenue grew 14%, led by hybrid cloud automation data solutions. Infrastructure revenue increased by 21%. Wow. Driven by 67% growth in the IBM Z mainframe systems. Consulting revenue only grew 3%. Showed steady but modest growth. So nice. IBM's actually pretty decent. Only a 21 multiple. It actually seems pretty fair. And that's a big dividend play. I forgot to mention the best part about that stock is the yearly dividend you get. Let me pull that up again. Oh no. Please low. Okay, there we go. Yeah, check this out. No matter what, you basically get 3% of your money back just in a qualified dividend every year. Pretty cool. What's your YouTube channel? It's called Nathan Robert. It's also in my link tree. You can just type in YouTube Nathan Robert. I greatly appreciate it, actually, if you want to watch a stream from YouTube. TikTok keeps removing my For You page eligibility and giving me a tough time. And this brokerage I'm on too. If you want to get this brokerage I'm on, yeah, okay. It's the very first link in my link tree there. All right, let's look at some more stocks here. Let's see. FICO. What's up, Header? FICO. This is an interesting one because we've all heard of like the FICO score. Basically, whenever you make a big ticket purchase, you buy a car or a house, you pay like a couple dollars for your FICO score. Basically, they've had tremendous pricing power over time because they're basically saying like, who cares whenever you go buy a $500,000 house? Who cares if you're paying if you used to pay $10 for your FICO score, now you're paying $15 for your FICO score fee. Like they've had tremendous pricing power because of that thesis right there. They got they got them in like the whole ecosystem like 10 years ago by having like really cheap prices. Now they're like slowly raising and have tremendous pricing power on the score business. But there is one bad sort of news that keeps sending this stock like this is why the stock fell. There's no earnings report this day, but the stock fell like crazy because of the government actually making their own FICO score competitor. So that's the one bad news around FICO right now. I think it's overdone it, but let's see. Yeah, here's what Morningstar research, here's what the bulls say, here's what the bears say. Oh yeah, so the FHFA decision to allow Vantage Score, that's what it called, Vantage Score for government conforming mortgages will alter its pricing strategy and could result in Vantage Score gaining traction in both mortgage and non-mortgage markets. So anyway, FICO, that they're basically having a new competition that they didn't expect, but they trade cheap, only a 29 forward PE. That is the cheapest FICO has ever been. And look at the expectations. Revenue's going to go to 670 million in 2 quarters. Net income's going to go to 241. Let's see the net income right now. Has it ever even been close to that before? And the revenue grew 16% year over year, so they do have nice little revenue growth. But they're projecting, what was it, 240 million net income. It's never even been 200 million before. So they really are projecting a lot of net income growth. Anyway, there's your FICO score stock. It's a niche name. Are you a swing trader or long-term investor? Yeah, T, I mainly just buy and hold stocks for the long run. Specifically, this portfolio right here, it's called my buy and never sell portfolio because once I buy a stock in here, I never sell it. But I do have this portfolio where sometimes I swing trade stocks in here, but I normally don't. It's also like a buy and hold portfolio. I'm thinking about giving the boot to Disney, maybe. I'm going to just basically move Disney into some higher quality, or basically a stock that I think will give me better total return potential in the long run. I also have a Robinhood portfolio. It's called my multiple. I have a dividend-only portfolio. I have way too many stocks, that's for sure. This portfolio is down 10% the past month. But yeah, there we go. Yeah, 10% the past month. But yeah, every stock in here does pay a dividend. I only got like 7 stocks in here. All right. Would you recommend Microsoft or Meta? What's up, Luca? Actually, I do own Meta. I'd recommend both of those. Like, both are so good and so quality. So yeah, I do own 5.1 shares of Meta. I'm a fan of buying fractional shares. No harm in that. So here's Meta right here. Absolute steal of a deal. The one thing being questioned on Meta is the AI spend, but that doesn't bother me. It's not scaring me out of Meta. Meta signs 5-year, $27 billion deal with Nebius. So yeah, they're paying Nebius $27 billion to rent out the capacity of their GPUs. Amazon Meta drive U.S. data center construction to record $45 billion. That's great for Comfort Systems. Actually, Amazon Web Services is the largest customer of Comfort Systems. But check this out. This is the one news that's bad for Meta. You know how they're spending billions, tens of $billions on data centers and GPUs to build up their own model? Well, check this out. Meta delays their AI model after underperformance and literally considers licensing Google's Gemini. So they kind of lost the war of, it's mainly just Google, Gemini, and like ChatGPT is the main winners, Claude and whatever. But yeah, Meta's a steal of a deal on the right. Meta only trades at 19 times forward PE. That is so cheap. I could not see Meta getting any cheaper. So they only trade at 19 times next year's earnings. And why are we looking at next year's earnings and not the current PE? You see on the left, they're at a 25 current PE because they had a total one-time adjustment to their EPS last quarter. It says they only made $1 of EPS. Well, that's not true. They didn't make $27 billion, had a total one-time tax adjustment accounting trick. They actually made their normal $20 billion. So only a 19 times net income. And yeah, the one thing being questioned is this cash from investing activity spend. They're spending more than they're making. This quarter, they spent $35 billion and they just guided they're going to spend $40 billion a quarter for the next 4 quarters in a row on more chips and stuff. So I also love what they're doing. Has anyone heard of like the Ray-Ban glasses? Meta Ray-Ban glasses. They're working on a smart a smart watch. Yeah, a watch as well, which is pretty cool. But one cool tailwind for Meta is that they're introducing ads because their main bread and butter is their ad business. They print money with Facebook ads. They make over $50 a year per Facebook user. Instagram prints money, but they're actually now introducing ads to Threads and to WhatsApp. After they acquired WhatsApp and the original slogan was no ads, no gimmicks, no games, they're now putting ads on WhatsApp. Let's go. As a shareholder, I guess I'm okay with that. But yeah, and Meta plans to workforce reduction exceeding 20%. Wow. So anyway, they're really going all in on this data center spend, and I'm for it. I'm buying the stock. I'm only up like 8% on them now, but pretty cool. You have a lot of knowledge. Are you a financial advisor? No, hey, none of this is financial advice. I'm not an expert. I'm in college. So yeah. Hey, what's up, Matt? And what about Kyle said, what about Boeing right now? So Boeing is the only aerospace and defense stock I actually won't buy, simply because they cannot get profitable. And they have actually been like the worst like performing, like if you look at the good aerospace and defense stocks like Raytheon, Lockheed Martin, Northrop Grumman, Moog, they're all at all-time highs, but not Boeing. They're not even at their COVID-19 price. And it's simply because of the financials. The financials explain it all. If we go to and they actually had an accounting trick. You see, this quarter says they made $8 billion in net income. Well, that was a total funny money accounting trick because they actually lost $800 million. But if we just zoom out, here's the money they're making. Here was before COVID. It used to be a good buy. They made like 2.8 billion a quarter, but then COVID happened. And look at, like, they legit have not made any consistent net income since 2021. All they've done since 2021, I did the math really, like, is cumulative loss, like 25 billion of net income. So the only thing with Boeing is we just want to see them get profitable, and they just can't. And they have a really leveraged balance sheet, a lot of debt to pay, and the debt just keeps going up because whenever you lose net income. So anyway, it's tough, but they've got a lot of new orders right now. Like, there's a lot of good, like, short-term news. Like, let's see, Treasury officials to increase Boeing aircraft energy purchase. Boeing secures $1.32 billion Chinook helicopter contract and $23 billion Boeing delays commercial aircraft. Well, anyway, I'm just not a big fan of Boeing. I own the company. I own Moog. They have a lot of patents that they have to buy off Moog. All right, let's look at some more here. Happy Sunday. Yeah, happy Sunday, Larry. Hope everyone's having a good day here. NextEra Energy. Yeah, this is a great regulated utility. I literally think no matter what you buy the stock, you should get, first off, you get a great yield. You get 2.5% in a qualified dividend no matter what. And you should get like 4 to 5% stock price appreciation on top of that. They own Florida Power and Light, which like local monopoly. They basically own all of Florida. They make $18 billion a year just from Florida. So if you live in Florida, you're most likely a customer of them. They're also getting into nuclear with Google. They have signed a Google nuclear like deal. I wonder if I can find that news. I know it's kind of old at this point, like a month old, so I wouldn't be shocked. Well, I guess my Wi-Fi is a little slow right now. Oh, come on. Okay, well. But yeah, this is a regulated utility, and basically, if they don't get 7% of their money back, or if they don't get like a certain percent of their money back, the government guarantees them that return. Like they give them like they're like 5 to 6% return. NextEra Energy receives approval for up to 10 gigawatt natural gas project. NextEra Energy and Constellation Energy trade at tech-like valuations amid AI data center power demand surge. Yo, I love Constellation Energy. That's my favorite one. Yo, hey, try not to spam and chat there. Which app do you use? Yeah, hey, this is a brokerage, Zion. It's the very first link in my link tree there. It's called Moomoo. It's a broker. So if you want to get it, it's in my link tree first link. So anyway, here's NextEra Energy. You get the great dividend. Here's their net income every quarter. They or I'm looking at the operating profit because they had a slight one-time adjustment. Says they only made like 464 million this quarter right here when they actually made like 1.5 billion of net income that quarter. So anyway, we look at a forward multiple. They only traded a 22 forward PE. That's right in line with what the regulated utilities trade at. This is the largest utility. If we go to ticker symbol VPU, which is a ETF I'm a big fan of. It owns all of the utilities by market cap. It fell 4% on Friday. This is a great ETF if you like dividends too. The largest holding in here is NextEra Energy because it literally is the largest utility. Largest one by market cap. Then it's Southern Company, then Duke, and then Constellation Energy. And I'm a big fan of this whole industry because I own a bunch of Southern Company and I own a bunch of Constellation Energy. I'll show you that right here. Southern Company is very similar to NextEra Energy. Literally, these regulated utilities just always give you 3% dividends, and then on average, like we can scroll out for eternity, just 3% stock price appreciation. And that's what's so cool about the VPU ETF. You literally should just, this always just gives you like 7-8% total return a year. Big fan of VPU, big fan of all picking and choosing your own utility stocks as well. Like NextEra Energy is good, Southern Company is good, Constellation Energy is great. I love all these. Yeah, and Florida's a nice state, you know. Yeah, hey, sorry, Zion. I gotta mute you there, buddy. Try not to spam, please. Thank you. It's in my link tree there. Very first link. Okay. What did I see here? Hey, yeah, no problem, Luca. Thanks for showing up. Thanks for those 8 roses there. I appreciate that. Peter said CCL, Carnival Cruise Line. I'm not too big of a fan of cruise lines because in a recession, these get smoked and these just don't, like certain funds out there go out of their way. Like they buy the S&P 500 and remove the cruise lines and the airlines and then they do great. So here's Carnival Cruise Line. They are the exact same price as they were back in 1998. So you bought Carnival Cruise Line in 1998. Well, it's the same stock price that it is today. These are fun to short term, maybe swing trade, momentum trade. I know these were big as like a travel boom play after COVID, like revenge spend kind of trade play, but just not a big fan of this one. It's like a long-term thesis. Like I don't really know if you're going to outperform the tech-heavy S&P just on a Carnival Cruise Line. I actually like Disney getting into cruise lines. Let's see if there's any news. Morgan Stanley upgrades them to overweight. Wow. So anyway, there's Carnival Cruise Line. It's a cruise vacation play. They're at like an 11 times net income. What's your major in college? I'm majoring in finance. Hi, Nathan. S&P Global, new position added. Let's check it out. That's a big holding of Warren Buffett, I believe. You know what? Let's go to his portfolio. Here's the Buffett portfolio right here. His largest holding is Apple and American Express. Oh, no, he owns Moody's. I mean, I think he might own S&P Global, but Moody's and S&P Global have a shared oligopoly on the credit rating business. So if you heard of the S&P 500, it's made by S&P Global. The S&P 500 pays royalties back to S&P Global because they have all the data. This app I'm on right now, Moomoo, all the data they get, like all these financial estimates, this is all data from S&P Global. So Moomoo pays S&P Global a bunch of money every year for their data. That's why I love this app right here. They have all the best data because they get it from S&P Global. Anyway, let me show you what S&P Global does. They print net income, but as we know, they have that credit rating business where they rate debt. Like the U.S. government has a credit rating, and like triple A plus bonds, or if you heard of that before, or like whatever, B plus junk bond credit rating, whatever they rank them. Oh, I just realized my phone just disconnected from the stream. I apologize. I have to reconnect this. Oh, geez. Yeah, sorry if I've been having Wi-Fi issues a little bit today. I apologize, but all I have to do is like recast it and we're good. Okay, S&P Global. So yeah, market intelligence. I like how diversified their revenue streams are. Then they have the credit rating business. That's 30% of all their revenue. Commodity insights, indices, and 60% of the revenue comes from the U.S. But if we go to their net income, like they really do print net income, and this is after tax. Before tax was 1.4 billion. After tax was 1.22 billion. So they're making over 1 billion of net income a quarter, fortress balance sheet, and they're actually investing a lot into the future. This quarter specifically, they spent like $500 million buying a company. This is their cash from investing activity spend. You want this to be negative, that means they're buying a company. This number was positive, that means they're actively selling out of their own assets. So I like when companies do M&A. Let's see what their dividend costs, because they're a big dividend company. So yeah, look, the dividend only costs $290 million, so they certainly have a lot of room to raise their dividend. They do the smart thing and they don't raise it, and instead do share buybacks. That's the most impressive part. 2.5 billion of buybacks this quarter. 1.2 billion the quarter before. So they do massive share buybacks, good dividend growth. It's just a safe company, and they can easily afford to do it all because they print net income. And all this quality company only trades at a 26 forward PE. So yeah, hey, I like what you did there, Logan. I really do like that stock right there. All right. All right. Have you ever thought about streaming on Twitch? I don't know. I don't know how to. I've thought about it. I've never done it before. I don't know if people watch finance stuff on Twitch, but yeah. Hey, thanks for that recommendation, though. Maybe I'll do it one day. Hey, what's up, Six Star? And I'm so behind on Stockshare. I apologize. Someone said UNH. I'll be really quick about this one. I just don't like this one because it's so much in the government's hands. You know what I mean? There's a lot of basically the stock only moves whenever they're allowed to raise prices on their like insurance, and only the government can allow them to do that. And one big fear right now is the margin collapse. So if we go to the revenue looks great. You think nothing's wrong with UNH right now. Everything looks great. Revenue's up 12%, but it's when we go to the profits. So the revenue's up 12, but the profits fell by 95. And this isn't like some one-time adjustment either. Like the net income was 200 million. That's after tax. Before tax, they made 380 million. And look at last quarter, it was down 50 and then 37. So this is a margin collapse story right now. Just basic gross margin metric. Just look at these year-over-year declines. It's down 22%. Last quarter fell 20, fell 19, fell 6, fell 9. And then the net margin was the worst part. The net margin was a 0.19 this quarter. So, basically they're no longer able to basically the stock tanked because it was true they were overbilling the federal government, and that was propping up their earnings in the past and prescribing people those like back brace they didn't need. So it's just a tough one. If the analysts are right, like if net income bounces back and really goes to 5.9 billion next quarter, I mean everything will be fine, but I don't know. I'm scared about the revenue is going to go negative. Revenue is going to go from 111 to 109. I just don't know. I'd be careful with UNH. Warren Buffett did just buy the dip on this one, though. So Warren Buffett, Berkshire Hathaway did buy the dip on them. Oh, I see some good names. Ooh, uh, it, DXY. I think that's just the dollar index. The Dixie, yeah, just a dollar. Is Reddit a good buy? Reddit is, in my opinion, a phenomenal buy. Yes, sir. Ooh, I see some other good ones. Like, sorry if reset your stocks if I missed any. I apologize if I'm missing some stocks here. I'm trying to get to all of them. But yeah, Reddit, I really think is a great steal of a deal. A lot of people think Reddit's just some meme stock, but they're no meme. They really do have insanely impressive revenue growth. They did 725 mil of revenue. If we just zoom out, that's what you want to see in a growth company. Revenue is up 69%. After grew 67, after grew 21, after grew 13. So the growth rate is growing, and not just the revenue that's growing, but the profits. So they did 725 mil of revenue. On that 725 mil, they netted 250 million in net income. If you annualize this number, basically $1 billion in net income a year, that makes this company extremely cheap because the market cap is $26 billion. So that means they only trade at 26 times forward PE. And another huge cherry on top for Reddit is the fact that they have no debt. Literally no debt. So whenever they make this 250 mil in net income, and more impressively, the 263 mil of free cash flow, that's all free cash, and it just adds to their cash pile. They have no debt to pay. They don't pay dividends. So whenever they make cash, their cash pile just grows. They have 2.5 billion of cash, and 2.5 billion of cash, when the whole company's worth 25 billion, 10% of what you're paying is just their cash on hand. And Reddit is getting a lot of high margin revenue from licensing out their data to LLMs, which is pretty cool. Advertising revenue grew 75%. Daily active uniques grew 19% to 124 million weekly active uniques. So just like really good metrics on Reddit. Their ARPU is like over $5 a user now, which is just so cool. Do you do options or covered calls? No. I'm really boring. I kind of just buy and hold great stocks. 6 Star said QQQI. I believe this is you buy this to maximize your income. So this actually sells covered calls on the NASDAQ. So this is something you want to sell calls on because you get a lot of high income. So basically you buy this to maximize your income. It's a covered call ETF. So you could sell calls yourself on the QQQ, but this one kind of just does it for you and takes a fee. So yeah, they have a 16% dividend and it pays monthly. So you'll never beat the actual QQQ, but you will get that high income. Hey, what's up, Emperor? He said PG. This is Procter and Gamble, one of the safest like consumer staple stocks out there. And it's a quality name to just buy and trust for the long run. You probably use a lot of their brands as well. They own so many brands that are worth over $1 billion, like Tide, Old Spice, Gillette, Huggies, like so many different brands. I could go on, but like they're in fabric home care, baby, feminine, family care products, beauty products, healthcare products, grooming. So they're in a lot of different industries. I like how diversified that they are. And this is their after-tax net income down here. This is probably the most impressive part. They really do make 3 to 5 billion of real after-tax net income a quarter. And what are they doing with 3 to 5 billion net income a quarter? Well, they pay a dividend, and that dividend only costs 2.5 billion. So you definitely can afford the dividend. It's a high yield. If you buy the stock now, you literally get 3% of your money back just in a qualified dividend every year. One thing that's hurting the stock, though, is just organic growth. It is a tough environment right now. If we actually go to their revenue, like look at this, it's low single digits. This is why I think the stock is having a lower multiple than normal. Like, look, lifeblood of the company, the revenue, it's only grew 1.5. Like, look at all these quarters. It's like 2%, 1%, negative 2%. So like low single digit growth. We kind of want to see the growth come back, but we can understand it's a tough environment, but they're still printing money. They're still making $4 billion net income a quarter, $4 billion of free cash flow a quarter, and they only trade at 19 times next year's net income. So it's a stock we've all name we've all heard before, and it's a nice stock I'd own as well. Uh, Thermo Fisher. This is like a testing, like a healthcare testing like company or like life sciences. I've never been too impressed by this company simply because they are a slow grower. Like they also have like single digit revenue growth, but I think they just brought back the double digit revenue growth for, well, okay, 7% revenue growth. Like another one where it's like single digit revenue growth is the growth rate all on the bottom here. Yeah, sometimes negative as well. But let me pull up, yeah, the forward PE is a 23. Let's see what AI has to say about this. So life science revenue grew 13%, laboratory products grew by 7, new product launches. So anyway, not so laboratory products, services, life science solutions, analytical instruments, specialty diagnostics. So that's kind of the industry that they're in. Here's their net income. They also print net income. Like this is real after tax. It's kind of been flat since 2021, but it's still good money, like 1.7, 1.9 billion a quarter. Good balance sheet and a good, well, actually a low dividend, but low payout ratio as well. I just kind of like to see more growth to that one. I think that's also why the stock has been flat since the year 2020, because the profits are the same as they were in 2020. So we definitely just want to see that grow. Can you rubric? Yeah, what's up, Finn? Again, there's so many stocks. I apologize. I want to get to all these. Like I see JP Morgan and hey, what's up, Plum? I appreciate that. And some other ones. Hey, what's up, Vulcan? Want to know about Archer in an aerospace play? Ooh, yeah, I don't love Archer Aviation because of their net income and bankruptcy fears, but we will check them out because I do want to talk about that and show you what I mean. And hey, Outwork, yeah, no problem. I appreciate you. Just recovering from a surgery. Do you have a favorite health stock? Yeah, actually, my favorite healthcare stock is actually a hospital group. This is HCA Healthcare. They're my largest holding in my Roth IRA. My favorite healthcare stock. AbbVie's really good, but I just love the hospital industry specifically. Like it's just such a safe, like long-term bet. And this stock, the best part is they buy back around 8% of the stock a year. It's unheard of. And you think I'm joking, but they really do for all of eternity have just bought back 8% of all the shares a year because the government really won't let them do M&A because they're already the largest non-governmental hospital group. Anyway, let's look at Rubrik right here. This is a cybersecurity software name. I love the growth. They actually just bought a company to bring growth even more. Actually, I wonder if we can get some, no, there's no analysis there. But basically, if you go to the cash from investing activities, they spent 2 quarters ago basically $850 million buying this company. So that's another reason why the revenue's been so growthy. But my favorite part about this stock is just the revenue growth. Look at this. The revenue's up 46 after grew 47. Like all the year-over-year growth on the bottom are all 40 and 50%. And if we zoom out, they just IPO'd in 2024, but it's just so impressive, the growth here. The bad news is they are still losing a lot of money, but they're narrowing their losses faster than analysts thought. That's another cool thing. So yeah, they expected 340 mil of revenue. They did 370 mil. They were expected to lose 99 million. They only lost 86 million. So it's definitely good to see them lose less money than expected. And we can see that income losses are just expected to narrow too by the analysts, going from negative 145 to only negative 78, and great revenue growth. And they beat on revenue every quarter. So it's just another software name that's really being hurt with all the other software stocks like ServiceNow, Salesforce, CrowdStrike. But I like this one because they're more of a cybersecurity name. We just definitely want to see them get profitable. They do kind of have a leveraged balance sheet. But I really do like that top line growth can't be made up. Let me pull up Archer Aviation really quickly. Let me show you the bad news around this stock. And there's a dilution problem and a bankruptcy problem. I wonder if there is any news. I bet there is. FAA selects Archer Aviation for 3 eVTOL pilot programs. Okay. I don't know if it's just like a rental space thing, but yeah, look at their revenue. So if we go to their right now revenue, this quarter, 2025 Q4, was their first ever quarter in history they made revenue. 300,000. So you're basically buying a company as they convert from a company that makes no revenue to finally making some revenue. Analysts are expecting 1.6 million and then 3 million in revenue. But the tough part is these losses. It's rough. They lose 200, like the losses are worsening. They lose like 150 to 200 million of net income a quarter. And when you make no revenue, how do you afford these net income losses? Well, it's actually share issuance. You're not going to believe this, but they've like you own like over 50% less of the company than what you originally did. Or I'll just kind of show you here. I always look for companies that do share buybacks. But look at this. When they IPO'd in 2021, I guess we can just start with here. There was 240 million shares. So it went from 240 million shares that exist. And now, and this isn't from a reverse split, this is from them issuing shares. There's now 715 million shares. You've been diluted just over your 60% after you get diluted 50%. So actually, you own like if you like technically when this IPO'd, if you own 10% of the original company when you started, you'd only own 1% of the company now if you just did nothing with your shares. Because they have to issue shares. They literally, here's the dilution number. They diluted you by 620 million this quarter, 820 mil that quarter, 300 mil this quarter, all to afford these net income losses. So it's just a really tough bet. Hopefully that made sense. Or I don't want to be too bearish there, but it's just the net income losses. But they are transitioning to their first ever sort of revenue. Any good ideas for an inflation play? I don't know. Usually just, inflation, whenever there's inflation, you know what a good hedge is? Just stocks, the S&P 500, usually stock, like as dollars are easier to get, market caps go up. But like bad inflation, high unsustained inflation will hurt stocks, but the market cap should go up in the long run. But yeah, just quality stocks. What about Iris Energy? This is a Bitcoin mining company converting to a cloud company. Well, basically, let's see if there's any news here. Buying 50,000 NVIDIA GPUs. So anyway, the only thing I don't like about this company is like there's nothing proprietary here, nothing like they have no secret sauce. Literally all they do is own a ton of NVIDIA chips. That's the only thing they do. They just own a bunch of NVIDIA chips. And what are these NVIDIA chips doing? Well, right now, 90% of the revenue is their Bitcoin mining revenue. These GPUs are used to mine Bitcoin. But right now, what's happening is they're getting a bunch of deals from I think Microsoft, where they're basically wanting to rent out the capacity of the GPUs. So instead of them mining Bitcoin with it, they're going to use it to basically HPC cloud hosting. So they've had good growth, like revenue. Oh, they missed this quarter. They expected 224 mil of revenue. They only did 184, and they missed on net income as well. But nothing's just blowing me away there. It's just like basically a company that owns a bunch of graphics cards. But it should do good kind of with NVIDIA, but I just be careful with that one. I just wouldn't have it as too big of a size position. General Mills, a pretty big pullback. Yeah, this is another food healthcare stock. I think at one point when I first started this account, yeah, I owned it for a week or something. Dang, September 2023. That's basically when I first ever created this Moomoo account. But General Mills, I like how diversified their revenue streams are. They own so many great brands. Like they're in snacks, convenient meals, cereal, what's that called? Cinnamon Toast Crunch. They're in dough. They own Pillsbury dough. They're in pet food, baking mixes, super premium ice cream. So they're very, very diversified. They're just struggling right now with just, revenue. Revenue's down 7.3. Profits are down by 21. They still print money. They still make like 800 mil a quarter. But as we can see, their profits have kind of been flat for a while. I think I said they're trying to spin off their Brazil business. I heard something about that. I wonder if I could find that news. I don't know. But anyway, they're trading at literally 10 times EBITDA. And I think just 10 times forward PE. Yeah, look, 10 times next year's net income. I mean, that's just really cheap. You get a good 6.5% dividend yield. I do think the dividend is safe. Maybe a safer play, but maybe like a Pepsi. How's Pepsi doing? Yeah, see, Pepsi's also struggling. Yeah. But yeah, the risk reward's starting to look pretty good on those. And it's not just, General Mills struggling. Like we saw Campbell Soup earlier. What's that? Campbell, is it CPG? I don't remember the ticker symbol for Campbell Soup. But anyway. Let's see what's next here. Let me type it in. It's all, you look at Campbell Soup right here. They're also on a massive decline right now. Same with Mondelez. So yeah. So don't think it's just a General Mills problem. It's kind of the whole industry. Best ETF for Europeans. I don't know. Actually. I actually don't know. Oh yeah, let's do JP Morgan. Yeah, sorry about that. You don't have a name, but you know who I'm talking about for the guy that said BX and JP Morgan. Let's do JP Morgan because I actually really like this stock. It's a good stock to put in your portfolio if you like dividends. And hey, Ishwar, what's up? We'll definitely look at JP Morgan. No. I mean, Dell. We'll look at JP Morgan right now. Had those mixed up for a second. So yeah, JP Morgan is a chunk off all-time highs. It was at 340. Now it's 280. Is there any news around this one? Probably not. Federal Reserve proposes 4.8% capital requirement reduction for largest banks. So I guess that's a bullish event right there. I don't know what that means. Oh, so they only have they have to have lower collateral. So if like basically you keep $100 in the bank, they only have to keep $5 at all times of your assets ready for you to withdraw or something like that. I think that means. I don't know. But anyway, JP Morgan's a great dividend growth stock. You buy the stock now, no matter what, you get 2% of your money back just in a qualified dividend every year. So you get 2% of your money back just in a qualified dividend every year. Let's see, do they have super cheap valuation. Banks always trade cheap. They only trade at 13 times forward PE, so 13 times next year's net income. Commercial investment bank, community bank, and an asset manager. So basically you go keep some of your assets with them. They collect a high margin yearly fee off that. And here's their net income. Why is this on cumulative? Well, here's the full year. Yeah, for the full year 2025, JP Morgan made $57 billion in after-tax net income. So that means they make every quarter basically $14 billion in net income. That's how they can afford to do a 20% dividend, or a 2% dividend, I mean. And that 2% dividend is only at a 20% payout ratio. 13 forward PE. So yeah, bank's too big to fail. Yeah, JP Morgan's a quality financial bank stock if you're looking to diversify into that industry. Because I don't own any banks for that. Actually, I own SoFi. SoFi's technically a bank. All right, let's see what's... Oh yeah, I said I'd get to Dell real quick. Let's do Dell. This is a better play than Super Microcomputer. Wow, I wonder if they're going up because of the Super Microcomputer news. This is bullish for them. U.S. charges super microcomputer for chip smuggling. Dell positioned to benefit. I believe it. Dell positioned to benefit because Dell has basically overtaken super microcomputer for installing chips and racks and stuff. So they only trade. It's like a value play. It's like a value stock. They only trade at 14 times next year's net income. They currently trade at 18 and it's going to a 14. So their net income is supposed to grow. Yeah, look at that. Net income is going to go from 1.16 to 1.67. And they beat like crazy this quarter. They expected 2.01. They did 2.25. So they really do make like close to, and that was after tax. Before tax was 3.15. After tax was 2.26. So they really did make 2.26 billion in net income a quarter. What are they doing with all that net income? Well, first off, they pay a dividend, and that dividend is so cheap. It only cost them 350 million a quarter. So they have so much room to raise a dividend, and notice the dividend cost is going down. It went from 396 to 340. How did the cost of the dividend go down? It's because they're buying back so much of their own shares. Whenever you buy back your own shares, you don't have to pay dividends to those anymore. So it makes the dividend cost less. So they're literally spending billions a quarter buying back their own shares. I believe they bought back 6% of all the shares in the past year. Here's an easy way to tell. The net income grew by 47, but the net income per share grew by 56. So actually they bought back 8.5% of all the shares, and they paid you a 1.3% dividend yield. No wonder Dell stock is pretty much at an all-time high right now. They're a buyback machine. Tailwind from Supermicro, only a 14 forward PE. Pretty cool. Actually, I really do like that one. Definitely looking to finally get in. Too big not to look at. Yeah, I agree there. Yo, should we look at some of the... Oh, I saw someone say SoFi too. Oh, we'll do AppLovin for sure. Is SoFi Technologies a good long-term investment? Yeah, I actually think so. They're a little expensive still. Ooh, and I see Norfolk Southern, I think that is. And Joseph said Microsoft. We'll check them out too. So here's SoFi Technologies. They are struggling right now. Was there any? Oh, yeah. One reason the stock is falling is because Muddy Water Research takes a short position, alleges $312 million in unreported liabilities. SoFi refutes claims as baseless. Again, $300 million in liabilities is nothing because they make like $200 million a quarter. They're going to make in 2 quarters $200 million of after-tax net income. So first off, the metric you look at if you're a SoFi shareholder that's led to a lot of the stock price appreciation before the past 2 weeks is the financial services business It is the most impressive growth I've ever seen. Like, look at these year-over-year comps. The revenue's up 78, after grew 85, after grew 115, after grew 195. Like, they're on an absolute streak of growth. Like, no analyst expected it to be this growthy. And we can see the analyst expectations. It's the orange line. And notice every quarter they beat on earnings. They beat on the orange line. They beat on revenue the past 3 quarters in a row. They beat on net income the past 3 quarters in a row. And that's why I think people are really starting to take SoFi serious. Like, this is the growth that you want to trust if you're going to buy and hold a, kind of growth stock for the long run, where the revenue just hits a new record every quarter. And the other thing is SoFi forward multiple is cheap. Like, if you look at their current valuation, yeah, SoFi's expensive at a 43 times net income, but this is a growth stock. You look at the forward multiple, SoFi only trades at 25 times next year's net income. And that's why now it makes this one look pretty interesting. And in full disclosure, I am a SoFi shareholder. I regret every share I've ever sold a SoFi. I'm still up a good chunk. Yeah, we only have 24 shares left, but even after this dip, I'm still up, dang, 185%. Same with Robinhood. I regret every share I've ever sold. These, like, some of my biggest regrets are selling out of great names. Like, look, I sold 50 shares. I had like 55 shares of Robinhood. I sold them all at 36 a share, and well, now it's $70. I'd be up like a lot more money if I didn't sell them. Yeah, SoFi is a good one for the long term. That 25 forward PE. I mean, really, I really do think like it can't get much cheaper. Let me go over Zeta real quick. Let me just go with Zeta. And we'll do BTE and Microsoft. Ooh, Astera Labs. That's a great one. And Apple 11 too. These are great stocks. So here is Zeta Global. It's a software name. Let's see if there's any news. Revenue surpassed estimates with 25% increase. Profitability improved with positive GAAP net income. That's great news. Free cash flow increased 76%. So basically, they're getting, for the first time ever, profitable. You're basically buying them as they transition from a software name losing money to a software name making net income. So yeah, look at this. If we zoom out, they made 6 million net income. That's so great considering they used to lose like 50 million a quarter. Now it's potentially where at the same time next year, they might be making a couple million of real net income every quarter. And they actually just acquired a company called Marigold, which is this advertising company I love. So yeah, they're doing a little bit of acquisitions as well, as I like to see, deleveraging the balance sheet as well. But yeah, basically it's just this revenue growth that's really impressive. Like literally every quarter, look at that. This quarter specifically was a new record. 400 mil of revenue, basically up 25% year over year. Let's check the free cash flow. Yeah, wow. They have stock-based comp, so that's why the free cash flow is, it's 55 mil, but the net income's only 6 mil because they have stock-based comp. I'm curious. So they're definitely going to be expensive, but that's because they're just now getting EPS positive. So yeah, look at that. They do have a forward PE. It's a 78. That's really expensive, but you really do like a peg for multiple year out forward PE. So actually, I do really like Zeta Global. I just want to see like it's just a bet on them transitioning to profitability. You want to be careful with. Probably don't have it as a too big of a size position yet. Yeah, Thermo Fisher is like the shovel and picks play for pharma. Yeah, because everyone has to go through them. So let me do Baytex Technologies real quickly. BTE, I've actually not heard of this stock before. I'm guessing it's an oil and gas commodity stock given the poor appreciation. Yeah, the stock is technically lower than it was in 2006, but they've done great the past couple weeks here, maybe because of the oil warfare. So it's a Canadian company, so we'll actually convert the currency to US dollars just to get a better idea of what they do. Let's go see the industry. So yeah, oil and gas. Okay. Oil and gas exploration and production specifically. Let's see what the revenue is. So that's like the actual revenue is negative. Is that right? That's weird, huh? I mean, like they make net income some quarters, but then the other I don't know. I'd be careful with this one. There's probably some more higher quality oil and gas exploration stocks than this one. Yeah, they're headquartered in Canada. Um, Canadian Sedimentary Basin and in the Eagle Ford. So basically, they own some rigs or something. Anyway, there's Baytex, some natural gas oil stock. I'd be careful with that one. I don't know. Hmm. I wish I could give you more thoughts on that one. That probably wasn't too helpful. What's up, Silver? He said VPL. What's VPL? So this is the Vanguard Pacific ETF. So is it like an international holding? So an ETF is just a basket of stocks. So let's go see what makes up the ETF. So the largest holding is Samsung. So yeah, it's all international stocks. So 6% of the ETF is Samsung. Then it's Toyota Motor, Bank of Australia, Mitsubishi, Sony. So interesting ETF here. So if you want exposure away from the US and just want some international names, I wonder, dang, Taiwan Semiconductor isn't in here. Taiwan Semiconductor would be a cool stock to put in there. Or I guess that's not Pacific. But anyway, there you go. That's a cool little international ETF. Yeah, pretty cool. Thanks, Sam. All right, let's do Astera Labs. I'll definitely get to Microsoft. Don't worry. We just covered them a second ago, Joseph. So I definitely want to come back to that one. Just give me a minute. Sorry if I'm taking a while on that one. But yeah, Astera Labs, not financial advice. Put this one on the watch list. They have impressive growth. Like this is a great growth stock, in my opinion. Revenue grew 92%, driven by strong demand in AI and cloud infrastructure sector. So yeah, it's a cloud infrastructure like components play. Um, so let me just show you the growth of this stock. I mean, you'll just see it for yourself. It's just so impressive. Every quarter, the revenue hits a new record. So they did 270 million of revenue this quarter, and on this 270 mil of revenue, they kept in net income 45 million. Look at the net income the past 4 quarters. They're finally starting to print real net income. And another huge best part is a huge safety net is the fact they have no debt. This is a debt-free company with $1.2 billion of cash, and the cash just isn't sitting there doing nothing. It's earning interest. That interest on their cash, they made 12 million of just interest on their cash. This is the kind of company that actually benefits from the high interest rate environment. Whenever interest rates are high, companies like this can literally just keep their cash in the 1 to 3 week treasury bills, milking high rates. That's what Powell Industry does, and all these other like Comfort Systems does. And Reddit, instead of like companies with a ton of debt right now because of the high interest rates paying negative interest, these make positive interest. So anyway, I just like the growth on this one. You can't make that up. The revenue growth, revenue's up 91, after grew 179, and it's just expected to go higher. Revenue is going to go from 191 to 309. So some sort of cloud AI beneficiary. Look at that forward PE, great improvement from its current PE of a 95. It's going to a 68. And I wonder what it is going to like the year after, maybe like a 40. So the sad part is it's still slightly expensive, but companies with this sort of growth deserve a high multiple and deserve to be expensive. All right. So, yeah, hey, what's up, Eric and Matt? Matt said AppLove, and this is my most recent software purchase. So if I head over here to my Webull account, here it is. Here's all my most recent purchases in order, and my most recent purchase in this portfolio is AppLovin. I am such a big fan of this company because I'm a believer fundamentals and financials always outshine in the long run, and this one has some of the best financials I've ever seen. Ooh, we'll look at Sony after this. I'm curious about that one too. So look at AppLovin. This is their total revenue this quarter. Actually, we can just zoom out as we can see one-time adjustment this quarter right here, so ignore that. But as we can see, the revenue just grows every year. But look at the total revenue number. It was 1.66 billion. Out of this 1.66 billion, they kept in net income 1.1 billion. And that's not some one-time adjustment either. That's after they paid 180 million of taxes. They really did keep 1.1 billion of net income after tax, which means what I'm saying is their net margin is a 66%, a better net margin than NVIDIA has. They make the little ads you see on video, on apps, on the App Store and stuff. So they literally keep, so if you go spend $100 on their ads, they keep $66.48 after tax. And then the free cash flow is just as good. 1.3 billion of free cash flow, 1.1 billion net income. And they can return that to shareholders. Actually, they're doing share buybacks. They can invest in the future. Just incredible margins, 90% gross margins, 66% net margins. The EPS growth is just off the chain. And it's not expected to stop either. Look at the net income projections. It's going to go from 820 mil to 1.25 billion. Just incredible. And I think, the risk reward's starting to look good simply because of this forward multiple. It's only trading at 28 times next year's net income. And someone said, is the AI distraction going to continue hurting AppLovin? Well, that could short term keep hurting AppLovin, but I'll keep buying. This is one I'm going to bet on for the long term because of these financials. A 28 forward PE. I really think the risk reward starting to look really good. So yeah, but if software names keep falling, like if Adobe and Salesforce and Microsoft just keep falling, I'm sure AppLovin will just, like a rising tide lifts all boats. It'll just follow whatever the market's doing and it'll fall with it. So yeah, rising tide lifts all boats. Haven't said that in a while. Okay, let me do Sony real quick. This one's actually pretty interesting. I see Peck. I've never heard of that stock before. Actually, then we'll do Microsoft after this. So here's Sony right here. They're actually seeing a lot of are hurting from the memory shortage for their PlayStation, so they own a lot of business. Oh yeah, look at this. Downgrade Sony Group cuts price target to $22 on memory cost in semiconductor certs. Like they are paying like the margins on PS5s have basically like almost I think gone negative because of the memory shortage, which is just crazy. So yeah, Sony's a big company in a lot of different industries, not just like PS5 and gaming. Like game and network service that's 44% of the whole business. Then they're in entertainment, music, and sensing solutions. Yeah, music right here. Check this out. They have so many big music artists signed to them, and they just collect royalties off the music streams. So and it grows nice double-digit growth. They own Crunchyroll. If anyone's heard of that streaming website, has anyone heard of High Anime? It just got taken down. The largest pirate site on the planet, and Crunchyroll lawyers just took it down. I wonder if that'll benefit Sony, or definitely will, because that was the website I used to watch One Piece. RIP. But yeah, the growth has kind of slowed down. I guess the revenue's only up 0.8% year over year. But anyway, I really do like Sony's net income. And they had a one-time adjustment this quarter. They make like 1.5 to 2.5 billion net income a quarter. The forward PE is what you look at. Sony only trades at 16 times forward PE, 16 times next year's net income. So they sell the PlayStations, and then the other profitable part is whenever you go buy a game on the PlayStation App Store, they keep a 30% fee on that game. So they just basically collect royalties. Yeah, here's the recorded music revenue. It was 2.4 billion this quarter, and you get a near 1% dividend, a very safe 10% payout ratio. They raise the dividend faster than inflation every year. So Sony's cool at like a 16 multiple. Pretty cool. So let's do Microsoft, MSFT. This is probably the safest and one of the best stocks I recommend right now. Like I would bet everything, like not financial advice, but like you cannot go wrong buying Microsoft right now. You should just get S&P 500 type returns for the rest of the time, just like 8 to 10% of your money back or something like that. Huge AI play. So if you want to exposure to AI, Microsoft's an easy way to do that. They own 27% of OpenAI and literally collect 27%. They have a revenue share agreement on top of the ownership where they just get 27% of every dollar OpenAI brings in, it just goes to Microsoft as a revenue share agreement. And they trade very cheaply. If you look on the right, I can't believe this. They only trade at 21 times net income or next year's net income. It just seems so fair. They are categorized as a software name. You look at all the software names, ServiceNow, Adobe, they are all have a similar chart just like this because Microsoft, their largest business is software. Think of, Excel, OneDrive, Office. That does over 120 billion of annual revenue for them. So that's big software name that could potentially get hurt. Like some people are saying like, oh, we don't need Excel anymore. We don't need all the blah, 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 or whatever. But they're also a big cloud play. Second largest market share behind AWS. The Azure cloud does over 110 billion of annual revenue for Microsoft as well. Another huge business, and they print money, and they have a better credit rating than the U.S. government. They print 30 billion plus in net income a quarter now, and that's what analysts are projecting. Next quarter, it's going to be over 30 billion of after-tax net income, and then 32 billion of after-tax net income the next quarter. They took some gains on OpenAI ownership. So basically, like they had a one-time adjustment making their net income look higher than it actually was because they took a basically realized gain on an asset. But don't worry about that. The record profitable quarter this quarter, 38 billion before tax, and this is the after-tax number. They didn't make 38 billion after tax. They really made 30 billion, but they had the adjustment. Anyway, Microsoft, I can't believe how cheap they are. I'm a believer. Every company, every S&P 500 company uses Microsoft in one way or another. So I use Microsoft every day, so hey, why not own some of the stock? And you get a dividend. They do share buybacks. All right, what's up, Mark? You said PEC stock. I wonder, does this stock exist? You mean DEC maybe, like Deckers? Let's see if we can find ticker symbol PEC. Did Claude have its IPO? No, Claude has not IPO'd, or that's Anthropic. Anthropic owns Claude. And actually, technically, 15% of OpenAI, messing up the names here, Amazon owns 15% of Anthropic, and Google owns another 15% of Anthropic. So it's Amazon's funny. They own like both sides of the game. Amazon owns OpenAI and they own Anthropic. So kind of funny. I have so many good things to say about Amazon, man. Like it's incredible. Amazon launches 1 hour and 3 hour delivery service. So basically, you can get a 1 hour delivery. If you're a Prime member, it costs $4.99, and that's like basically a personal assistant at any time. You can literally have something delivered to you in 3 hours. Like sometimes it's worth paying like $5 for that emergency where you don't want to drive. OpenAI signs deal with Amazon AWS to provide AI services. Look at this: NVIDIA to supply 1 million GPUs to Amazon AWS. I'm like, what is the price of each GPU? If a GPU costs $100, and it's probably definitely costs a lot more, that's $100 million for NVIDIA. But I bet each chip costs like crazy revenue. Oh, look at this. Amazon projects AWS revenue could reach 600 billion. 600 billion just AWS. That's the most valuable part of Amazon. Their Amazon Web Services right here. Right now it does 130. Well, right now it's like 150 with the growth that they've had the past few quarters. They do 150 billion of annual revenue on AWS. And I guess he's projecting 600 billion. That's like, I can't even believe those kind of numbers. But yeah, Amazon's a great never sell stock. They're the number one Fortune 100 company. There's no other company in the world that does more revenue than Amazon. They do 200 billion a quarter or 720 billion a year, and it only grows. That was for the past year. And so the revenue's at a record. Like, look at, if we just zoomed out, record revenue. You don't want Amazon as your competition. And not just record revenue, record profitability. This quarter specifically, 25 billion, most profitable quarter they've ever had. It's like a margin expansion play on Amazon. And if we go to their cash from investing activity spend, like this is why you don't want to compete with Amazon. They will outspend you, out-innovate you. They spent 47 billion just this quarter. That's my favorite part about Amazon. They don't pay dividends or do share buybacks. They reinvest it all into the business to just get good net income growth and own good assets and beat their competitors. All right, let's look at more here. What's up, Brian? He says EUAD. This is the European Aerospace and Defense ETF. Oh, I bet Rolls-Royce is a big holding in here. Let's see. So they have BAE Systems. Actually, oh yeah, there's Rolls-Royce. So 4.12% of this whole ETF is Rolls-Royce. So yeah, these are all, I guess, European aerospace and defense stocks. And you know, aerospace and defense is kind of a popular sector right now. Actually, speaking of AWS, we're talking about cloud companies. Another huge, this is basically a pure cloud play company. You know, AWS is like 20% of Amazon, but Oracle, 90% of the revenue is their cloud business. And this is they have the 5th largest market share. So obviously the number 1 market share is AWS, then it's Azure Cloud, then it's Google Cloud, and then it's Oracle, or 4th largest market share. And then it's Oracle. They have like a 6% market share for cloud. Basically, I have my cloud exposure via Google Cloud and Amazon. So I kind of just don't own Oracle because they kind of have too high of a dividend payout ratio than I'd like and a debt problem. Let's actually see if there's any news around them. But they have a huge backlog. So let's see. Oracle plans 50 billion cloud infrastructure spend. Basically, they cannot afford this spend right now. Oracle plans reduction of 20 to 30,000 employees. Dang. Oracle expands chips. AI agent to emergency departments and inpatient settings. Saves over 200,000 physician hours. Okay, well, anyway, let's go look at their earnings. They trade at 24 times PE. That's the same valuation as Amazon and Google. Google's at a 26 and Amazon's at a 25. So it's kind of like, well, anyway, let's just go look at their numbers, and I actually want to show you the backlog of this company because that's the most impressive part. They have, so retaining performance obligation reached 553 billion, and that's up 325%. That's basically from OpenAI. OpenAI gave them like a $300 billion contract, and basically that's the remaining performance obligations. They're owed this money, and they haven't fulfilled that yet because they don't have the infrastructure to fulfill it. So right now, like, look, they spent 19 billion this quarter. They have no cash left. They have a ton of debt, over 100 billion of debt. They make 3 to 4 billion net income a quarter. They had a one-time adjustment this quarter. They make like 4 billion net income a quarter, but they pay 2 billion in net of that in dividends a quarter. So basically, they have $2 to $3 billion of leftover money to pay with a quarter, and they spent 20 billion this quarter, and they're planning on spending like 30 billion for the next 3 quarters in a row. So basically, they're issuing a ton of debt to do this. They basically have to spend a bunch. So look at that's another free cash flow metric. Negative 12 billion of free cash flow, negative 10 billion of free cash flow because they're spending way more than they're making. So it's just like a toughly positioned cloud company, but I still think they'll do good. But I'm kind of just have my money on AWS. Um, I think Amazon's a safer buy. And it's the same valuation. Yeah, my phone does need charging. Dang, we're on 18%. Luckily, the last couple percent last longer and hits different. Amazon will see a trillion revenue by 2030. I really think Amazon might actually be one of the most valuable companies one day. All right. What was this one? BX stock. What's up? Let's try out BX stock. Blackstone. Oh, this is your PC company. The private credit or private equity businesses have been crushed recently. You know, it's not just Blackstone. Look at BlackRock. Look at Blue Owl. They look just as nasty. And this actually creates a decent opportunity. Look at the yield. You know, you buy the stock right now, no matter what, you're getting 4.3% of your money back just in a qualified dividend every year. So it's actually a pretty solid dividend, and the forward multiple is only a 10. So you'll only trade at 10 times next year's net income. But there have been some bad news about like withdrawals. Yeah, they were I guess they were faced 3.7 billion withdrawals, redemption cap reduced to 7%. So yeah, here it is, third line here. Blackstone fund faces 3.7 billion withdrawal request. Wow. So Blackstone fund reports 0.4% monthly loss, first decline since September 2022. Private credit industry faces over 10 billion in redemption requests amid market concerns. So, they did an acquisition. Blackstone completes acquisition and funding deals in technology and pharmaceutical sectors. Well, what was the company? So they majority stake in an advanced cooling technologies in a 400 million life sciences funding agreement with Teva Pharmaceuticals. Anyway, yeah, so private equity, taking equity in private companies, and that's 34% of the business. Then real estate, credit, and insurance. So I like how diversified that they are on, like real estate, insurance as well. Look at that. I just clicked on credit and insurance. Look at this annual revenue growth. You know, that's really impressive for the full year 2025. Let's go to their net income down here. Yes, they do good. They do make good net income, like 1.5 to sometimes 2 billion in net income a quarter, and only a 10 forward PE. I guess it's just this stock really just trades around the sentiment around, I guess, the private equity market. Hmm. Interesting there. All right, what's next here? CT Real Estate, CT REIT. I hope I can find that stock for you. Are you talking about CTRE? That's the REIT I just bought. Or he said CRT. There's Cross Timbers Royalty Trust, but I don't think that's what you're talking about. Um, I can't find. Give me the name of the stock. Oh, actually no, we just found it. No way. We did find it. My bad. Here we go. It's called CT Real Estate Investment Trust. So that was the name. Okay, we found it. Let's go see what they own. So they're a Canadian company. Let's convert the currency to US dollars. Ownership management of primarily triple net lease. I guess it doesn't want to load for us. But anyway, let's go see what the dividend is, because REITs always have high yields. Yeah, you get 5.8% of your money back just in a dividend every year. So yeah, you're getting a really good dividend. Let's go check out their website to see what kind of properties they own. Properties. Let's click on that right there. Wonder what like their top 10 customers are. So yeah, all their properties are in Canada. Okay, I guess here are their top tenants or something like that. I haven't heard of these because I don't live in Canada, but here are maybe their top tenants. Yeah, maybe go an investor. They have an investor presentation, maybe. Not seeing. I want to see a presentation. Oh well, it doesn't matter. Well, there you go. There's CT Real Estate. Let's see what their gross margins are. Usually really high. Yeah, 80% gross margin. So let's go see if their dividend is safe. So you do a dividend payout ratio. Oh, look at that. Speaking of Canadian Tire, one of their top customers were Canadian Tire. It looks like the Canadian Tire company is the largest shareholder of this one. They own 14% of all the shares. They're a customer and a shareholder. So they make 85 mil a quarter. And then look at this. So the dividend costs 38 million a quarter. So as long as they make over 38 mil a quarter, they can afford the dividend. And they definitely can afford that down here. And I believe they can afford it with net income. And you really don't even look at net income because you add back the depreciation and the amortization, which is this number. So anyway, I actually like that REIT. Nice. The REIT I just bought, yeah, you said compare it to my recent REIT. This is the REIT I just bought. And again, a REIT is just a real estate investment trust, which means 90% of their assets are real estate. This one is a senior housing specialty nursing one, which is an industry I like, and they have a really good growth. Like, check out this revenue growth. It's super impressive. And another impressive thing is the Fortress balance sheet. They could pay off all their debt in zero point 0.5 years. And if you go to their dividend, you get 3.8% of your money back just in a dividend every year. So you get 3.8% in a dividend. I think you should get like a good stock price appreciation as well. 11 consecutive years of dividend increases, a safe 74% FFO payout ratio, 0.7 debt to EBITDA. And these are like their properties right here. These they actually just acquired this huge UK company for like $700 million, but I really like them. It's Care Trust REIT, and I think the senior housing business should do more like recession resilient than a lot of other, maybe like, it's not like Amazon exposed, like certain retail stores, like certain REITs I look at like go for like properties that like aren't affected by Amazon and e-commerce and stuff. But Care Trust, it just like AI proof business model, you know what I mean? Or anyway, and triple net lease, safe payout ratio, good dividend. And so that's why I actually just bought them for the first time ever in my Roth IRA. I don't have much shares and I'm down a little bit. Yeah, we got 6 shares. We're down 3% of the position. But yeah, we do own some of them. That's my most recent purchase. And I just did a huge deep dive. Actually, if you want to help me out, go watch my most recent YouTube video. I just did a huge deep dive on that stock. And I did a big deep dive on AbbVie. Actually, my most recent YouTube video is called High Dividend Stocks to Buy Now or Dividend Stocks to Buy Now. Every stock in that video has a dividend yield of well over 3%. And I think that they're my favorite stocks over a 3% dividend yield. And I analyze them the same way I do here. Do you like Amazon or Google better? I think they're 1-2 related. Yeah, these are, I like Amazon and Google both so much that I own both of them. Like, they are so good. Like, it's just like buy both. Like, there is no, they're both so great. They're both never sell stocks that should do both amazing together. It's like, like you're asking me, do you want to buy a stock that's going to triple your money or another stock that'll triple your money? Like, it's like, you know what I mean? Or anyway, Google's cheap. Like, even though they've held up a lot better than a lot of the other Mag 7, they're actually cheaper than some of the other Mag 7. Like, they're cheaper than Apple, Tesla. They only trade on a forward multiple of a 25. So Google trades at 25 times next year's earnings, and they're a big grower. Like, they own so many businesses in one. The Google Cloud business has had specifically really good growth. They grew 47% year over year, after grew 30, after grew 25. So the growth rate's growing on their Google Cloud, but they own so many other businesses as well. Like, they own Android, they own YouTube, they own the Google Play Store, they own Waymo, they're in quantum chips, they're in TPUs, they're selling TPUs to Meta. They own 7.5% of SpaceX. They this is an ETF in one. You can't go wrong buying Google. They literally are a money printer. They make like 30 billion of after-tax net income a quarter. Fortress balance sheet. You get a dividend. They do share buybacks, and Google is investing a ton into AI. Like, Google Gemini has done so well. Like, a year ago, people were saying, "Oh, Google's going to get replaced by ChatGPT," but now Google Gemini is like almost like the preferred LLM. People love Google Gemini. I love Google Gemini more than ChatGPT. So. Yeah, Google's great, and it's a never sell stock for me. Another one I do own, they're in my dividend only portfolio. I'll show you that here real quick. Yeah, which hasn't done too well. Yeah, full disclosure. Yeah, look at this. The past month we're down 10%, but yeah, Google's my largest holding in here. We're up still 85% on them. We bought them like pretty much a year and a half ago, and they've been a great never sell. And they're still like cheap. Like, that's why I'm not selling. I still wouldn't sell or trim Google like at a 25 forward PE. No way. They're going up higher, I think. All right. It's like the Walmart Home Depot of the USA. Oh, hey, cool. Thanks for that, Narc. Yeah, hopefully that was helpful there. Let's do PGY, and then I see Grab. Yeah, we'll do Grab. Super Micro, Tesla. How is the PSEC dividend possible? It's unsustainable. For sure, Silver. That's another BDC. The reason they have such a high dividend, Silver, is because they're a BDC. But we might check that one out. This is a really interesting software name. I'm really serious about this one because they have a super cheap valuation. They did miss on earnings, but they're so cheap to the point where, like, how much lower can they go? Let me show you what I'm talking about here. In net income multiple, they currently trade at 11 times net income, but on next year's earnings, they only trade at 7 times net income. That is so cheap. Like they could buy back so much of their own stock with that net income. And I think maybe it's like, look at this. I think the stock fell this quarter because they did miss on the revenue, the lifeblood of the company. They expected 349 mil. Only did 334. So they did miss by a little bit, but they beat on net income. They expected 32 mil. They did 34. And they slightly beat on EBITDA too. So it was still good growth. This is the revenue trend here. Oh man, hold up. Oh, okay. Yeah, sorry, they're saying I'm AFK. Hold on. All right, sorry if the stream went out for a second. We're back. Thought I was AFK. But yeah, I still like the revenue growth. It just hits a new record every quarter. And it's not just the revenue, but this software company is now super profitable. And this is real too. This is their before tax number. Before tax, they made 65 mil. After tax, they kept 30 million on that. So they really are a super profitable software name. A lot of software stocks right now are tough buys because they're losing a lot of money and they're really expensive on a forward multiple, but not this one. Only a 7 times forward PE. Let's actually, is there any coverage of this stock from Morningstar? I want to get an idea of what this company does. No, Morningstar does not cover them. So let's go look at their website real quick. They're headquartered in New York. AI and data networks for the financial industry. Oh, I think they help out like loans, or I don't even remember. It says its products deploys data science, machine learnings, and AI technologies to evaluate customer applications in real time. No, something like that. Some sort of software name. But anyway, I just like the cheap valuation. Like, I don't know how much lower it can go at a 7 forward PE. Yeah, risk reward. I actually really would make that a super, super small position. Like if you wanted that as 5 for a couple percent of your portfolio, like 5% of your portfolio, do not make it 5% of your portfolio today. But maybe go ahead and make it 1% because it is really interesting. I just don't know if they have a moat or like I don't know too much about what they do, but. So yeah, let's do grab stock. I'm actually really liking this mid cap, or it's like a small cap almost, or no, mid cap, a $15 billion company. This is international Uber. So what does this company do? They literally do exactly what Uber does, but internationally. So if we go to where their revenue comes from, this is my favorite part about the company. The fact that their revenue doesn't come from the US and Canada and UK, it comes from all these niche companies, countries like Malaysia, Indonesia, Singapore, Philippines, Thailand. And that actually this is a genius move by Uber. Uber has a tough time penetrating in these markets. So what does Uber do? Uber buys this stock. So first off, this stock is backed by Uber. Uber owns 13% of all the shares. It was absolutely genius, gives Uber instant international diversification. And first, let me say, I am more bullish on Uber than I am Grab. Uber just acquired Spot Hero. And NVIDIA just partnered with them. Google just partnered with them. Amazon just partnered with Uber. I'm the most bullish on like Uber stock, first off. But Uber owns 13% of all the shares, and Toyota Motor owns 5.5% of all the shares. So they have some great backing and great growth. Like, look, they're the most profitable they've ever been. This is another great thing. So if we look at them a year ago, it was a tough buy. They lost like 100 or 50 mil a quarter. Well, now they're the most profitable they've ever been. They made 100 million this quarter. And at this growth rate, what are their profits going to be this same time next year? Well, we can see from the analyst. Let's see. They're expecting 80 mil next quarter and then 88 million of net income the quarter after. So I'm really impressed with Grab. I like the international exposure, basically international Uber. Let's see, Morningstar have anything to say? Yeah, look at that. Grab operates in mostly emerging markets. Delivery business competes with several other peers in low profitability industry. Okay, well, anyway, they're backed by Uber. I really like Grab. They're still a little expensive, but that's because they're just now getting profitable. They're at a 39 forward PE, but again, they're just having their first ever their first ever earnings. So the price to earnings ratio really do like a peg and multiple year out forward multiple. Would I buy Supermicro Computer? I used to own Supermicro Computer. I actually sold them not even that long ago. I sold them for a good like 30% gain. Yeah, there was my sell order right here. Look, so I sold, I guess this was fortunately timing. I sold all my shares at $31. And I actually bought them during this there. I bought them at $26. So I bought them at 26. I sold it for 31. I made a little bit of money. I sold out of Supermicro because of financial issues I saw, margin compression issues, and because they kind of just do a commodity. Here's the bad thing. If we just look at basic metric gross margin, you're starting to kind of see what I mean here. The gross margin on Supermicro, like this doesn't even include all this news that they are smuggling chips into China. to prop up their sales, and the co-founder is now arrested for it. So sentiment's terrible, but the reason I sold them and why I still wouldn't buy Supermicro is because of the margin collapse. They're giving customers these bulk deals because they just sell a commodity, and there's a lot of increased competition from Dell, so they have to lower prices. Their gross margin is down 50%. Like, look at all these year-over-year declines on the bottom. So gross margin's down 46 after it fell 23, after it fell 17. So like massive, that's their gross margin decline. Look at the net margin decline. Net margin is down 44 after it fell 30. After it fell 37. So if we just zoom out to their net margin, they used to have a respectable, 8-10% net margin, but now it's just like so low single digits because it's just a commodity. So really, I the sad part is, I'd look for other AI stocks to buy on the dip. Like there's some other ones that are on a dip that I think are like Astera Labs. This one's also on a dip, could be a better buy. ARM is really good. ARM's a royalty company. Did y'all know that? ARM is actually a really cool stock. I'm actually looking, I'd love to own this one. This is one of the most quality chip stocks. Like they make the energy efficient chips that use way less electricity. They're in like every iPhone now. Basically, if we go to their business right here, here's what's so cool. Look at this. 62% of the revenue is their royalty revenue. And the other half, the other 40% is their licensing business, which is super high margin. So if we go to their gross margin, literally 98% gross margins. And their net margins is around a 20% net margin right now. So they do make good net income, but the net income's not high enough to have a good multiple. Like, here's the thing. I'd love to own them, but look at this stupid high multiple. I'd love to own them, but it's too expensive at 124 forward PE. But they are on my watch list because it seems like a great business model. I can see why they're super expensive because they're just quality. So Mark said Tesla. This is gotta be one of the sadly like most overvalued stocks in the market. Tesla and SpaceX to build joint semiconductor factory Terafab in Austin for AI and space chips. Musk states 80% of chips will be deployed in space, 20% for ground use, targeting production of 100 to 200 billion 2 nanometer chips annually. So they're making their own fab in Texas. Geez, that's pretty cool. Is there any news here? But it's still tough, Yeah, basically, I've looked at the 2030 EPS multiples. They're pricing in so much future growth from robo-taxis and robotics. That's why, that's why there's still a crazy high forward PE, because I guess the growth is coming in like 5 years from robo-taxis and robotics, but I just don't believe it's going to be as growthy as people think. Like Google Waymo's already running, like it's going to be so commoditized. Both of these robotics are going to be so commoditized where they won't really have a good margin on them. And with robo-taxis, like Google Waymo and Amazon Zoox and a Tesla Cybercab and Uber's own robo-taxi thing. Like the cost per mile and the margin is going to be super low, I think, unfortunately. So that's the tough part about Tesla, and they kind of lost their growth. If we go to the Tesla's revenue, the lifeblood of the company, this is a growth stock. Well, the growth is negative. The revenue is down 3% year over year. And actually, not just the revenues that's negative, but the margins collapsed even more. So the revenue's down 3%, and the net income right here, and dang. So actually, look at this right here. I want to pull up both margins here just so we can get a better idea here. So the net margin or the net income fell by 60%. You'll be like, look at all the net income declines on the bottom. So yeah, gross margin right here. Actually, gross margin did spike up a little bit, actually. Gross margin's up, but yeah, I guess it's just like another one where they used to have like these 10 to 15% net margins. But now it's like kind of low single digit net margin after they lost their like EV tax credit beneficiary. So we just want to see the growth come back to Tesla. Like if we go to their main automotive segment here, like on an annual basis, it's been flat or it's been down since 2023 right here. But their other business, their energy business, has actually been really growthy. Look at this one. Grew 25% year over year. So the bad part is it's just too expensive to own. But I do want to see Tesla do good because Tesla props up a lot of other stocks. Whenever Tesla's doing good, a lot of other smaller momentum names also do really good. Yo, what's up? The AC says, how do you like their prediction market or CME stock? So I actually don't do prediction market stocks because the prediction market stuff, like on Rob, it's pretty much just gambling. But it's sometimes fun to do. Like I've only done one prediction market ever, and it was on the Super Bowl. I put $20 on the Seahawks to win just to make the Super Bowl more fun to watch. And hey, the Seahawks won, so I guess I made money on that. Oh yeah, here's a prediction market. But yeah, it's pretty much just gambling. But I like it as a business model, like Robinhood. So whenever you go buy and sell a stock on Robinhood, they only keep a 0.1% margin on that. But whenever you go buy and sell a prediction market contract, they have a 2% margin on it. So it's 20x more valuable. So right now, Robinhood stock is printing money because of these prediction market contracts. And here's CME Group. I wonder if it's maybe another beneficiary of the prediction markets you're saying there, the Ace. Let's check out this company right here, CME Group. So, oh yeah, so they're in interest rates, equity indexes, energy, market data, agricultural commodity index, others, metals, foreign exchange. So I like how diversified that they are. Geez, and the multiple isn't expensive. They only trade at 26 times next year's net income. So pretty fair valuation, only 26 times next year's earnings. Let's see what the market cap is. Dang, they're a huge company. This company's worth $110 billion. They pay a dividend. You get a 1.6% dividend. Not too shabby. And yeah, dang, revenue is up 8% year over year, but the net income is up by 35. So that means, yeah, their net margin boosted up to a 71. That's insane. Look at that. So the revenue was 1.65. On this 1.65 bill of revenue, they kept 1.18. So that really is a 72% net margin. The free cash flow was 1.1 billion. So that means the free cash flow to sales is a freaking like 70% as well. I'm actually going to add them back to the top of my watch list. That's so impressive. They have insanely good margins. I mean, I just can't believe it. And a 1.7% dividend yield. I actually really like that stock. Congrats. Hey, what's up, The Burge? How's it going? I imagine high oil prices will affect Grab's profitability. Actually, no. I mean, because Grab, they're kind of like Uber. They don't own the cars. They don't own the drivers having to spend the gas money. They just collect the fee every time you go book a Grab or book an Uber. You know what I mean? Ooh, Spotify? Yeah, this is your music streaming business. They just made their free like ad tier subscription a lot better or something. Um, I guess what is this? Spotify receives downgrades on revenue concerns. Additional daily fines of 0.05% are being levied for each day. Wait, the Turkish are imposing a fine of 0.05% of turnover on Spotify for obstructing an on-site inspection. Or I don't know what they're talking about there. Anyway, Spotify's a great subscription model company. It's easy business model to understand. They only trade at 30 times next year's net income. That's the cheapest I've ever seen Spotify. So yeah, here's their monthly active users. So they have 750 million monthly active users, and 470 million of those are ad-supported people. So that means their premium users, so people paying for their premium subscription, is 290 million people. And that is up from 263 million. So yeah, they have a lot more new people paying for their premium price. So yeah, premium revenue is 80% of their revenue. And look at that. It does 18 billion of annual revenue for them. It was 4.7 billion this quarter, up 22%, after grew 10, after grew 21. Geez, so they're on a nice streak of growth here. And if we go to their bottom line here, this quarter specifically, they have never been more profitable. This is the most profitable quarter Spotify's ever had. 823 million of, profits. So yeah, revenue's at a record. Like if we just zoom out, like that's what you want to see for a growth company. Revenue just hits a new record every year, every quarter. Profits are at a record this quarter. Good balance sheet that's deleveraging. The liabilities were 54% of the assets. Now it's only 44. And the free cash flow is the best part. Yeah, look at the free cash flow. Basically $1 billion of free cash flow a quarter. So the only bad part is like they don't own the music. Universal Music Group owns the music, and every time Spotify raises prices on their subscription, they ask for more and more royalties and ask for more money from Spotify. That's the only tough part. And also, it's a total commodity. Like I used to pay for Spotify. Then I switched over to Apple Music, and then I canceled Apple Music and switched over to YouTube Music because YouTube Music comes free with my subscription. Dude. My cousin uses Spotify and I use YouTube Music. YouTube Music has copied exactly what Spotify does. Like it's kind of, and anyway. All right, let's see here. Yo, Michael Anthony, what's up, dude? PAGS started paying 26 dividend. Let's check it out. ICE Intercontinental Exchange. Yeah, we'll check out Intercontinental Exchange. I think they just bought a stake into Poly Market. Has anyone heard of Poly Market before? ICE or ICE stock, which is Intercontinental Exchange, not to be confused with a different ICE, took a 10% stake in Polymarket. So let's check out PAGS. This is PAG Sergio Digital. Yeah, they did just pay a dividend, 26 cents. Let's see if they can afford that. And I'll Oops. I can show you a really easy way if a company can afford their dividend. It's just you look at the EPS. If the EPS is higher than 26 cents, then they can afford it. So yeah, look at this. They pay 26 cents of net income a quarter. Well, they make over 35 or 30 cents a quarter. So Sergio equals safe in Spanish. Oh, hey. Interesting. So I wonder, yeah, look at that. So they're headquartered in Brazil. So that's one of the reasons I'm going to assume the stock has a low multiple. Is just because whenever you're headquartered in Brazil, like I see this all the time, like you just like get a lower multiple for some reason. But they're in the the digital payment software industry, and look at the valuation. This is the crazy part. They only trade as 6 times current PE and 6 times forward PE. So they trade at legit 6 times net income. Yeah, so 98% of the revenue comes from Brazil. So it's like a pure Brazil company. If you're bullish on Brazil, this could be a good one. But operating profit is negative, but net income, that's super weird. How is the operating profit negative, but net income positive? That's a complete headache. I don't have an answer for that. I've never seen that ever. That's weird. Like they are making net income every quarter. And they're printing free cash flow. But why is the operating profit negative? I don't know. Here's the EBIT. So I guess EBIT, earnings before interest taxes. I guess that's what you should look at. Here it is. Yeah, 125 mil, 130 mil. So I don't know. Interesting Brazil financial stock. Maybe what was the dividend? You get a 1.5% dividend, and the payout ratio is only an 11%. That's what happens when you only trade at 6 times net income. You can have a super low payout ratio and have crazy high dividend yield. So reach the full potential of Latin America with our one-stop payment solution. Offer over 140 local payment methods. So I guess if you're a merchant, merchants from all over the world are expanding using them. So you can maybe, if you're a business, maybe you can, in Brazil, accept other forms of payment from tourists that maybe wouldn't you have before. I don't know. Hopefully, something like that. Hopefully, that was kind of helpful there. So they're headquartered in Brazil. Oh, Moody's. Hey, yeah, let's do Moody's real quick. That one's a Warren Buffett holding. And then after Moody's, let's do, I see Salesforce and ICE. We'll do ICE after this. I live there far east. I probably prefer to get it. Yeah. So here is Warren Buffett's portfolio. Actually, let's see what he just did. Let's see if he bought any new positions. So new positions. So the only stock he bought this quarter was the New York Times stock. What did he sell out of? He didn't sell out of anything. No sellouts. He increased his Domino Pizza position. Lamar Advertising. I love this read. They are the number one. They have a 60% market share for billboards, and there's no more billboards being built. They're all grandfathered in. So Lamar Advertising is really cool. So anyway, back to Buffett, though. I want to get to Moody's. Here's his portfolio right here, and Moody's is 3.5% of his portfolio. This is a Buffett-type stock because it's a great moat. They have a shared oligopoly with S&P Global for the credit rating business. Let's see, is there any news? Moody's chief economist warns U.S. recession probability at 49% as oil prices surge. So I guess that's not good. With U.S. losing 92,000 jobs in February and GDP growth slowing to only 0.7. So I guess, definition of recession is 2 quarters of negative GDP. So anyway, here's Moody's right here. Yeah, pretty fair multiple at 28 forward PE. So only 28 times forward earnings. Moody's Investor Services. So yeah, it's great for the full year 2025. Nice 15% growth year over year after it grew 17, after it grew 18. So they're also in Moody Analytics. Pretty cool. So let's go check out the bottom line here because that's what matters. What net income? So yeah, they print money easily. They're making 600 plus million of net income a quarter. So that's how they pay a dividend. You get basically a 1% dividend. They raise it every year, faster than inflation, a safe payout ratio, and they do a bunch of buybacks as well. Let's see if we can get any earnings analysis on this company. So Moody's Investor Services grew 17%, driven by strong demand in their ratings businesses. Moody Analytics revenue grew 9.3%, with recurring revenue compromising 97%, reflecting steady growth. Operating margin expanded, healthy profit. Cool. Anyway, pretty cool at a 28 forward PE. It's a Buffett holding. I love the shared oligopoly business model. So let's do ICE real quick. ICE, which is Intercontinental Exchange. And if anyone's heard of Polymarket before, they're like a huge betting prediction site. They took a stake into them, I believe. Actually, I want to double verify that. You know what? Let me just add. Did they take a stake in Polymarket? And we'll come back to this in a second while it kind of digest that for me. So anyway, let's go look at their earnings here. So yeah, exchanges. So they literally own like the stock exchanges like that. I don't even know how to describe it. But yeah, the exchanges, fixed income and data services, and mortgage technology. Like, so look at the mortgage technology revenue. It's actually doing really good. I wonder if they're like a mini Redfin, or like a mini what's it called? Like a Rocket Mortgage or something. So anyway, exchanges revenue. Let's just look at this one right here. So yeah, I mean, nice little steady growth here. Let's look at the net income down here. So yeah, here's their bottom line. Easily 800 plus million of after-tax net income a quarter. They also have a dividend, a 1.21% dividend yield. Let's see what Morningstar has to say. ICE has become increasingly less resilient on transactional revenue as it expands. If trading volume declines, we expect the firm to be less affected than in the past. ICE owns highly valuable proprietary data assets that has been able to monetize effectively. With the acquisition of Ellie Mae and the purchase of Black Knight, ICE has opportunity to benefit from the digitalization of the mortgage industry. Pretty cool. So yeah, they are in the mortgage industry. Here's what the bears are saying. Mortgage technology could continue to struggle if mortgage rates remain high. Well, duh. ICE is highly acquisitive. Why can't I say acquisitive? I've never said that word before. They acquire a bunch of businesses. Acquisitive. Okay, I'm like stupid or something. Okay, 25 forward PE. Let's see what Moomoo had to say. ICE announced a strategic investment of up to $2 billion in Polymarket. The investment valued Polymarket at $8 billion pre-investment. Others say $9 billion. So that's actually pretty cool. They bought $2 billion of an $8 billion. So they own 20% of Polymarket. That's actually pretty cool. That's actually an interesting fact. I'll actually put them kind of on the back of the top of the watch list here. Any cool? They seem pretty cool at only a 24 forward PE. That seems pretty cheap. Another one. Oh, I'm so going to forget the ticker symbol now. TradeWeb, it's TW. TradeWeb's another very cool like market indices index stock right here. I was watching CNBC like a year ago and it said data provided by TradeWeb. So I just typed in my brokerage TradeWeb and well, here's the stock. And they have some of the most impressive numbers I've ever seen. So net income soaring and they're a fortress balance sheet. They have no debt. Let me actually go and add TradeWeb back to the top of the watch list. That's another cool one you could put there. Yeah, and you get a dividend with TradeWeb. All right, let's check this out. Moody's versus Jeff. Wait, Jeff, is that a stock? JEFF or Jeffries? Oh, yeah, Jeffries Financial. Yeah, you really would compare like Moody's versus like an S&P Global. There's like Fitch as well, but I don't think they're public. But yeah, here's Jeffries Financial. What do they do mainly? Investment bank. Yeah, so they're mainly a bank. Look at that. Investment banking, and they're also an asset manager. I love asset managers because you just collect like a high margin fee on the assets that you manage. So yeah, here's this company's net income. It looks like it's lower than it was in 2021, but they still make like 100 to 200 mil in net income a quarter, it looks like. Interesting there on Jeffries. All right, I wanted to get to this stock. All right, I keep saying QQQI. Hey, what's up, GNST? All right, let me do QQQI for him. This is a dividend ETF. So you buy this to maximize your dividend income. So it basically sells calls on the NASDAQ, and you really wouldn't want to sell calls on the NASDAQ because, you know, you're always going to get, that's why the income's so high because there's such a high probability you're going to get called as the NASDAQ just continues to always climb and climb higher. But this, you buy to maximize your dividend income. They pay a monthly dividend, a 16% dividend. It just sells calls on the NASDAQ. So yeah, there you go. I'm always kind of a fan of selling calls yourself. What's the expense ratio here? So not too bad, but it's still pretty high. So 0.68% expense ratio and a management fee of 0.68. So I'd just be careful with QQQI. Actually, well, you just buy it to maximize your income. If you're in the income stage, that's a good one. But if you're young or something, you're better off just putting it in the S&P 500 because that definitely won't keep up with the S&P 500 or the Nasdaq total return. So let me do Salesforce, and then Steven said Abercrombie and Fitch. Yeah, we'll look at a couple more here. Then I gotta go. Dang, we've been live for over 2 hours. This has been fun. I appreciate y'all. Yeah, if y'all want to hit the follow button, we stream every Sunday at this exact same time. So hit the like button too. We'll be live for another like 10 minutes. So here's Abercrombie and Fitch. It's that like clothing company. And these always trade cheap, like retail, in the mall or something. They only traded 8.4 times PE because, they're a commodity. Trends always change and stuff. Like a year or two ago, Abercrombie and Fitch was really in the trend, but now I don't know if it is as much. But they still print money. Like they're easily making 100 to 200 mil in net income a quarter. Great improvement from what it used to be in like 2019. They used to really struggle with profits. Like they'd make money, but then lose money. But now the company is consistently making like 100 to 200 mil in net income a quarter. No dividend on the company. They cut it, which I'm actually okay with. So an 8.4 forward PE. I guess net income is going to fall. They're only supposed to make 58 mil next quarter, 111 mil the quarter after. But I don't know. It kind of remind me of like a Gap. Like, dang, technically the stock is just barely higher than it was in 2007. Like they kind of remind me like a Gap, or what's it called? Like an American Eagle stock. Like here's Gap company. What's American Eagle? Is it AEM? That's Agnico Eagle. American. I wonder if I can. American Eagle Outfitters, AEO, yeah, like a stock like this, like where it's the same price that it was in 2005, but these always move like cyclically, where like as you can see, they always move up and then move down aggressively, and maybe you could catch the swing trade on that. But not one like just this whole industry. This industry as a whole, like whether it's Abercrombie and Fitch or American Eagle, just not a great long-term hold to really outperform the tech-heavy S&P 500. There have been some better performing like shoe companies like Decker Outdoors. They're on a bit of a dip right now, and I think they're probably oversold. This is probably one of the better buys if I had to buy some sort of shoe clothing stock on a dip. Deckers is really cool. They own like Hoka, UGG, and the growth has been really strong, taking market share from Nike. But yeah, all the stocks like that are struggling. You should look into cover calls. Yeah, I have before. I have done cover calls. I'm just I don't want income, and I don't want to sell calls on a stock that I want to own. Like I would not sell calls on like imagine I at one point I actually did I could have got like 30% instant returns on Powell Industries if I did a covered call at like a 20% price that was higher, but thank goodness, like basically I don't want to sell my stocks. Let's see what's next here. David, he says, would you want to buy Noble or Noble? Is that like a stock? Oh, NE stock or individual high paying dividend stocks. Well, you'll love my most recent YouTube video. I go over a bunch of high dividend yielding stocks. All of them have well over a 3% dividend yield, and they're all my favorite high yielding dividend stocks. So my most recent YouTube video, I just made it if you want to watch that and help me out. My YouTube videos don't get many views, so check it out if you want. But yeah, here's Noble stock right here. They've actually had some really good stock price appreciation. Check that out the past couple of weeks here. A lot of tech and the S&P is struggling, but not this company. So they have some sort of defensive nature. Are they in like oil and gas? Yeah, they are. So they're in contracted drilling services. So they are. Oh, look at the dividend. So yeah, you get 4.3% dividend. I guess they're saying the payout ratio is 150%. So maybe a bit of a too high of a payout ratio. Yeah, they do oil and gas drilling. Let's see if they have real revenue. So they do, but like all oil and gas stocks, it is negative right now. Like even on Chevron, Exxon, the revenue is negative year over year. But it's the future sentiment where oil prices are higher now, so where they're definitely going to be making more money in the future. Their price to break even is way more better. So yeah, the negative revenue, don't worry about that because it's really the future expectations. That's why the stock I think is going up right now. So anyway, just some sort of oil and gas company. Again, I don't know if this one. I don't know the thesis on this one. I should look into more of their assets. Like I know, like I'd like ExxonMobil the most. Like ExxonMobil, like look at this one. That stock was the same price that it was in 2023. Well, ExxonMobil is at an all-time high. Like same with like a Chevron too. So I wonder about that one. But they certainly seem interesting. A 44 forward PE. So I guess, yeah, I don't know about that oil and gas stock. Silver said CAL. What's CAL? We'll check that one out. freaking CAL. Calories, or they're a very small one. Oh, and then I see SEHD too. We'll probably, yeah, well, the last stock will be SEHD we look at. Right? That's an ETF. So here's Calores or something like that. They're very small. You just got to be really careful. If you look in the top right, the whole entire company is only worth $360 million. So that is a really tiny market cap. Oh, but they do footwear, famous footwear. I guess, dang, so that's not great. The revenue is negative year over year. I kind of want to see what shoes they sell. I've never heard of this brand before. Maybe I have. I guess we'll just go to their website and figure it out. If it load here. Private label footwear. So, I want to pull up their website if it load. Maybe their website's glitched and it won't load for me. Or maybe it's my Wi-Fi. I don't know. I'll try it one more time. But, oh well. Because I'm not a big fan of this industry. All right, well, we won't look at it. All right, so anyway, footwear, brand portfolio. We just don't want to see negative revenue. Okay, so revenue is actually positive year over year. Revenue's up 8.7%. If we zoom out, so it's kind of been flat for a while. Like the revenue's technically like lower than it was in like 2013, or it's like the same revenue they were making in 2013. And here's the net income. They have improved their net income though. Actually, they are making good net income every quarter. Looks like look at the past 4 quarters specifically though. Like they had like barely made any money, like super low million, like a couple million a quarter. Then they lost 20 mil this quarter. And it wasn't a one-time adjustment either. Dang, look at their operating profit. So yeah, the margins really have been going down on Cal right here. So that's actually bad news. I can see why the stock is pretty much at an all-time low right now. That's unfortunate. Let's pull up SEHD real quick. Yeah, this is a great dividend ETF. If you're looking to get high dividends, SEHD pays a really good dividend. So no matter what, if you buy it, you get 3.5% of your money back just in a qualified dividend every year. And a lot of its stocks, of these boring kind of stocks, are the ones that have been doing great so far this year. Think of like a Lockheed Martin, a Chevron, a ConocoPhillips, which are oil and gas. An Altria, a Coca-Cola, these have been doing very well. And so that's why SCHD has been doing like a lot better than normal this past year. So yeah, you buy this for the 3.65% or 3.5% dividend yield. I've like made my own SCHD. I own AbbVie, I own McDonald's. Uranium stock UUU. Yeah, a cool uranium ETF is just ticker symbol URA. If you don't know what uranium stock to buy, you could buy ticker symbol URA. Look at how good it's done since 2019. But yeah, here are all its top holdings, and 4% of the portfolio is in UUUU. I will say I've looked at all the uranium stocks. I will say that if I had to trust one, I'd put it in Cameco. Then my second favorite one would be a LEU. Is that on here? Centrus Energy, yeah, LEU is 3.25%. And then my third favorite would be a UEC. They bought a uranium mine off Rio Tinto, which is really great. And then I haven't actually looked into UUUU. So let's actually see if they have revenue. Let's check it out. So they do have revenue. That's good. 27 mil of revenue. But I did see, yeah, so they actually consistently lose money every quarter. I was looking at UEC, LEU, Cameco. They actually make money every quarter. So I just don't like the fact that they still lose a lot of money every quarter. But I guess they are narrowing their losses. They lost only 20 million this quarter. So that's great. And the revenue did decline 30% year over year, but it's probably really cyclical. Let's see what the expectations are. Yeah, they're supposed to narrow the losses. Great news. Okay, yeah, they're only supposed to lose 5 million in 2 quarters, and the revenue is supposed to go from 4 million to 32. So actually, there's a lot of future growth coming for this company. So there you go. Probably really expensive though, unfortunately. Oh, I meant MOBL. Oh, MOBL. Unfortunately, I typed in MOBL. They're just not on my brokerage. I can't view MOBL stock. I do apologize there, David. I did try and find it. Oh, yeah, Norfolk Southern. Yeah, I think they're trying to merge with like Canadian Pacific. Anyway, this is a railroad company. I love this company. It's like a boring company. You probably get like, you won't outperform the S&P 500, but you should get like 6 to 7% of your money back a year. You get a good dividend. You get basically 2% of your money back just in a qualified dividend every year, no matter what. But yeah, and this is what they ship inside their trains. Agricultural forest products, they ship chemicals, they ship metals, construction products, they ship coal. Does anyone remember that huge like town in Ohio when that huge like car, basically they had a huge chemical leak that like gave a bunch of people got a bunch of people sick a long time ago. Anyway, yeah, they do a bunch. They make good net income. They do dividends and they do share buybacks. So yeah, and I think they're trying to merge with some other. They're trying to merge with some other railroad company. Um, the U.S. board directs Union Pacific and Norfolk Southern to submit additional information for merger. Oh, maybe Union Pacific's trying to buy Norfolk Southern. Huh. That'd be crazy. I've actually owned Union Pacific. Um, they're another great railroad company. But yeah, anyway, that wraps up the stream. Let me end this with a quick portfolio update. I appreciate everyone that's here. I stream every Sunday this exact same time. If you want to hit the follow button, please hit the like button too if you haven't already. It would help me out. And subscribe to my YouTube channel. Again, best way to support me is subscribe to my YouTube channel and go to my YouTube, because YouTube or TikTok keeps removing my for you page eligibility. So TikTok stream is just cooked, but YouTube one's pretty good. So anyway, thanks to everyone on YouTube. But yeah, here's my dividend-only portfolio. We haven't done too well. We're down 10% the past month, 7.7% year-to-date. We're still green 11% the past year. Here are all the stocks that we own in here, all dividend names, of course. Here's my total percent change. We're only down on Carlyle Group right here, but yeah, we do have a lot of tech-heavy names like Google, Meta, Constellation Energy that has led to us being down pretty bad the past month here. We also have a Roth IRA. A Roth IRA is just a tax-free retirement account. I'm trying to bring the growth back, and we have a lot of bad performers. Like Weeble's been struggling, Cormedics too, but we did just buy for the first time ever Care Trust REIT, my new favorite high-yielding REIT. I also bought a little bit of Cavco. Here's my Moomoo account, known as my buy and hold, never sell portfolio. This account's done really good year to date. Let's see. Yeah, all time, since we started this, we're up 242% return money weighted, and still year to date, we're up 29% versus the S&P 500 down 5%. And that's mainly led by these great names like Comfort Systems. Still, even on the little dip that they have, they're still up like 48% year to date, which is pretty insane. Powell Industries is still up 70% year to date. Coca-Cola's up, Coca-Cola Consolidated, this is the bottler, COKE, not KO. They're up like 50% year to date. Amphenol, Moog. So yeah, that's my buy and hold portfolio. The reason it's done so well is because I haven't trimmed. Most people, when they're up like 100 or 200% on a stock, they usually sell or trim a little bit, but we're not going to do that, because one of my biggest regrets, especially in this portfolio, is selling out of stocks for a win. Like Robinhood and SoFi are two of my biggest examples. Like I regret every share I've ever sold of these stocks. Like Robinhood, I had like 58 more shares. I sold it at 36. Well, now today it's $70. So anyway, we're going to see what happens if we just diamond hand it. Make sure to come back in a year or something and to see how we're doing. So anyway, see y'all soon. Make sure to check out the YouTube channel. Oh, check out my most recent YouTube video. I go over 4 high yielding dividend stocks to buy now. My favorite high yielding dividend plays. They all have over like a 3.3% dividend. And they're not just going to give you 3% dividends, but also 3 to 4% stock price appreciation. And some of them I own. I go over Care Trust REIT. That's one of them I go over. I also go over Southern Company and AbbVie. This is like the biggest steal of a deal right now, AbbVie. It's the very first stock I cover because I think it's the best deal right now. Go check it out. Anyway, see you soon. Or go leave a comment. If you leave a comment on the video, say you came from the stream, I will leave you a nice reply. Anyway, see ya. Thanks again. Thanks to everyone on the YouTube stream. 6-Star, Narg, Plasma, Supercar, Galaxy, David, the member Brian Paul. Thank you to everyone so much for being on the YouTube stream. See you very soon. Make sure to hit the like if you haven't already. Also, watch out for people impersonating me. I sell nothing. I have no course book, WhatsApp, Telegram, Discord. I don't coach. I sell nothing. Just on here, give my opinion. Definitely not financial advice.